Good morning. Working? Yeah. How's everyone doing? Let's do in step fix. All-time high on NQ again. Yep. Yep. Every 30 minutes or so. Nothing weird. 5,600? Quite a bit of resistance before we get to that. But 85 seems fine. We'll probably stay above 75 unless JPOW says something off, which I guess is possible. Yeah, having a bitch of a time finding this fucking hearing, though. Oh, maybe this is it. Good morning, Ghost. Huh, okay, well, that's it. I found it. Nice. You're just pumping in case he says something bearish. Yeah, largely. Yeah, Matt, hit your price target. Nice. I'm still in it. Lost it a little bit there, too. Let's stay. Stay in it, see for retest. I'll put a stop on it, though. Thank you. Um, hmm. Okay, cool. We are forming a little bit of a top on ES. I don't know if that means this is going to pull back anytime soon, though. There's support at 75. Frankly, right here, we have a little bit of support at 85, too. Call interest at 90. 90 is picking. 90 and 95 is picking up. Not at 5,600, but at 5,605 and 5,610. So those are probably sold. So a little bit of short call risk layering up to the upside. I wonder if we'll be able to hold here for very long. Almost tested monthly VN at open here. Yeah, like $1.50 short. The amount of event risk priced in here is awkward. What is solar dump when I finally enter? I don't know. It's doing fine. Well, depends which one you're in, but FSLR looks like it's doing alright. Bouncing right back to open. Let's see. So Tesla's up. Ooh, I wanted to watch that. Yeah, my max is at like 58 here. Okay. Volatility's not really doing anything. Options are... I feel like options are underpriced this entire week. Still quite underpriced. Especially with CPI and shit coming up on Thursday. We're doing JPOW slip up puts. I mean, not necessarily slip up. It's sworn testimony. It depends on if he gets asked about bank health or not. Or if anybody gouges him on CREs. Possibly if anybody gouges him on monetary policy, too. Ooh, GoEV's doing a thing. Neat. The video's still picking up market cap, though. These are overpriced. Jesus. $33.78. 130. 32. Interesting. What time is the testimony? It's gonna start in like 14 minutes. Time for Gork to open 600,000 syntholongs at $2. The time's already passed, York. Has SPX ever gone over SPX WGM? Yes. Yes, it has. Although that's generally when VN is above GN, which it's currently not. Hmm. Hmm. Amazon failed the 200 test again. Let's do that. Just looking for an entry there. 55.85. Hmm. How's BTC holding up? 0.8. Dollar's about flat. Yields are moving up a tiny bit. Are you streaming JPAB? Yeah, I'll stream these. I'll stream it. You think Amat still has VUP juice left in it now that it passed 250? It in fact does. Although I think upside's gonna get like a lot grindier from this point forward. Like 55 and 60 positioning's kind of weak. It'll really depend on if more positioning starts to come in at this level. Bounced back. What did 28 in the pre-market? What did the data this morning look like? Business optimism moved up. Redbook is up. Ooh, used car prices are up. That's awkward. What did Barr say? Did he say anything important? No. Redbook rising on falling inflation's gotta be not a good sign, right? I see used car prices down 60 bips. Mm. I was talking more the I'll show you. Trending less negative, yeah. Flattening out, it looks like. Mark Steely, welcome to Zillionaire. Thank you so much, man. That was the wrong speaker. Hit me up on the Discord. I'll get you added to the country club after the stream, man. I appreciate it. What's your PT for Ulta? It's on the chart. Still long oil's after refinery margins news. Are you talking about barrel from the tropical storm? Any chance of AVGO breaking below 1700 in the next 2 weeks? No, it's pretty unlikely. It's got quite a lot of support at 1750. I mean, if it loses 1750 again, maybe, but it's got a bit of a ramp to the upside built out. So it'd have to fail quite a lot of the positioning that's been coming in. QQQ is close to being 500, Gerg. 500, QQQ, 500. Yeah, I know. Conductor market is overpriced. No shit. Decreased profit margins from ZOM BP refineries. I didn't see that in the news. It's mostly bullshit. Well, something's got to keep the CTAs from getting squeezed out. Gherkin, 1 year ago, I was shorting QQQ at 300. Now look at us. Are you still shorting QQQ at 300? Last week I tried to exit a profitable put position, but I cannot sell even at ask. Decent volume. What are the factors at work here? What to look out for? Thanks. Was the volume? What do you mean by decent volume? That can be relative, but also what was the OI? Because I assume you mean you couldn't sell at the bid, but that doesn't make sense. So the spread was really wide. Q scene, Powell walks to his desk with aviators, a smoldering cigar, and American flag boxers, sits down, looks Senator Warren in the eye, and whispers, I am inflation. SPX flash crashes to 900, then 7,000, and the confusion. That'd be cool. Just give me like 45 seconds at 900 to close some stuff, and I'd be okay with that outcome. Hold on 1 second. I just gotta. Generational dip buying opportunity. I mean, yeah. If the market went to 900, I'd buy some. Just as much as I could, actually. All right. Let's see what sort of fun stuff we got going on here. um, that and this. Right. Oh, is that gonna work? There we go. I'll slot VIX up here, I guess. None of these have come quite as high as I want them. That's a nice bounce, so that's doing pretty good. Still want to short this. That failed. Microsoft failed. All right. Powell could slip up and say banks are in a little bit of a rough spot. Banks are in a little bit of a rough spot. Are they shorting beyond really hard, actually. Yeah. GME is also getting shorted really hard today. Mm. Fun stuff.
Ohioans know, Americans know that our economy fundamentally is not a fair playing field. Instead, we have a David and Goliath economy where the largest corporations use their power to funnel all the gains in the economy to the top, aided and abetted by too many people in this room. Corporations squeeze every last penny from Americans' pocketbooks and workers' paychecks. They don't even try to hide it anymore. The biggest corporations are charging more for less. Americans are frustrated. No, actually, Americans are pissed off. They have fewer and fewer choices. Those choices cost more and more. Keeping prices down is part of the Fed's mandate, but as many of us have made clear, the Fed's main tool to combat inflation,
This guy always starts off
raising
so
interest
bearish. I
rates,
love
does
it.
nothing to address the biggest causes of rising prices right now: corporate greed. Keeping rates too high for too long threatens workers' paychecks while keeping other costs high, particularly housing costs. Housing prices and rents continue to go up. It's no surprise that since the Fed began raising rates, the amount of income families need to qualify for a mortgage has nearly doubled. Homeownership has long been a bedrock of our middle class, but today fewer and fewer middle-class families can afford to buy a home. Higher interest rates are making our country's housing supply shortage worse, not better. We need more housing construction of all types. Higher rates lead to the opposite, and particularly make it harder for multifamily construction to work financially. Higher interest rates make borrowing more expensive for working families, whether it's for a mortgage or a car or anything else. Most people don't have the luxury of paying for everything in cash. And for the millions of Americans feeling their budgets stretched by higher prices, taking on credit card debt to pay for groceries and other essentials has become an option of last resort. But as more people struggle to pay down their debts, credit card interest rates are reaching all-time highs. Last month, Director Chopra testified in front of this committee.
Have they not considered printing money?
Credit card issuers are charging higher rates far beyond what they need to cover their costs. Corporate greed rearing its head again. Banks are making record profits at the expense of cash-strapped Americans. Every month that the Fed keeps rates high, Mr. Chair, it costs Americans money by making it more expensive to buy a house and to borrow money. Higher borrowing costs stifle future economic growth, leading to fewer homes being built, leading to businesses making fewer investments in the economy, and eventually, if the Fed doesn't stop, leading to workers losing their jobs. As they set economic policy, I urge the Fed to weigh these trade-offs and remember whose jobs and futures are at stake. It's why I've worked with my colleagues to hold corporations accountable and will continue to do that. For instance, we fought to cap insulin prices for senior citizens. We'll continue to fight to extend this price cap on life-saving drugs for all Americans. And why my colleagues and I on this committee are working, it's why we're working to lower housing costs for more Americans. The Fed also continues its work to keep the banking system stable and ensure consumers' money is safe. Last year, the Fed and other bank regulators issued a proposal to update bank capital requirements, strong capital standards, and you've heard in this committee overwhelming support for strong capital standards. They're critical for the economy. It's our way of making sure that if Wall Street bets go poorly, which they often do, investors, executives, and shareholders should pay for it, not taxpayers. The biggest banks have spent obscene amounts of money attacking this Fed proposal. But you, the Fed, don't work for big banks. You work for the American people. Your concern should be developing capital rules that protect Americans' money, not protect bank CEOs' stock portfolios. The Fed needs to look past these shameless lobbying efforts and finalize a rule in the best interest of taxpayers. Another
could fill
dangerous
most
piece of
of
the
the
Wall Street
gap.
business model that makes our banking system less safe is incentive-based compensation. This compensation model rewards risky behavior that enriches Wall Street executives in the short term, but makes banks more likely to fail. We saw the results of that model in 2008. We saw it again last year with the failure of Silicon Valley Bank and Signature. Other regulators have moved forward with a proposal to rein in these reckless incentives, but the rule, Mr. Chair, can't move forward without your and the Fed's moving on it. This rule is long overdue. The Fed must join this statutorily required effort as soon as possible. The Fed also has the important job of reviewing mergers and acquisitions between and among banks. Over the last several decades, we've seen the largest banks grow into massive, literally trillion-dollar companies, while thousands of small banks in rural communities in Northwest and Southeast Ohio, in small towns in those areas, and all across America have disappeared. Consumers have lost trusted local banks. Small businesses have lost longtime reliable banking partners. Regulators like the Fed have the crucial job of guarding against mergers that reduce or eliminate competition and lead to bank closures or layoffs. I recently sent comment letters to the OCC and the FDIC on their current efforts. I expect the Fed to take the proper steps to ensure that its merger review process is robust and that it protects consumers and communities. Finally, Mr. Chair, you must ensure the Fed has high ethical standards. Fed officials should never again be able to profit from their positions by using confidential plans about Fed monetary policy and emergency programs to pad their investment portfolios. The board's latest update to its trading rules is simply not good enough. It still fails to establish the clear penalties needed for Federal Reserve officials who make investments in violation of the public trust.
Wait, hold on.
Consequences
Is the Fed
really not
allowed to
much
trade
rule at all.
again?
The American people need to be able to trust that the Federal Reserve works for them in a time of deep cynicism that people have about the federal government overall. The American people need to know that officials aren't abusing their positions for personal gain. As chair, you have an important role to play to make sure our economy works for everyone.
This is a big deal. Hold on.
The Fed's regional banks must do their part to hear from people and other stakeholders in their 12 districts to understand their needs. I look forward to hearing today how the Fed will balance its dual mandate, how it will protect Americans' money, how it will foster an economy that upholds the dignity of work. Senator Scott.
Thank you, Mr. Chairman. Thank you, Chair Powell, for being with us this morning. Welcome back. Joe Biden broke this economy, and it's been very difficult to fix it. That's the bottom line. I want to start with the end in mind. Joe Biden broke our economy, and it is very difficult for anyone to fix it. Everyday families are struggling to put food on the table. Real wage growth is being eaten away by rising prices and runaway inflation. Think about the fact that for 52 consecutive weeks under Joe Biden, wages were eclipsed by inflation for 52 consecutive paychecks. I remember back in December 2020.
We just have been
South
eclipsed
Carolina
by
gas was
inflation for
$1.99
52
per
consecutive fucking
gallon. Today, it's
years.
still $3.19 per gallon. A 50% increase in just a few years. So it's devastating to the average American family, particularly families like the one I grew up in, a single parent household mired in poverty. When you see your gas prices up 50%, your food up 30%, your cost of keeping your house cool or warm up 25%, it's not a challenge. It's not unfortunate. It's an absolute crisis. And too many households in America today are living paycheck to paycheck, and they fear the challenges that are coming our way.
That
The
doesn't
headwinds
fit the
brought to us by
agenda.
the Biden
Oh,
administration.
sorry.
Those headwinds, of course, are seen through the prism of inflation. Inflation hasn't been this high since the Jimmy Carter years, and that devastation is being felt and measured in households by too much month at the end of the money. And that devastation is real for the vast majority of Americans. And the pointing finger, I tell you what, whether it's the Biden administration throwing the Fed under the bus or any other way they can deflect from the real problem. I've seen it, committee hearing after committee hearing after committee hearing. My friends on the left want to point their fingers at anyone other than the real culprits at 1600 Pennsylvania Avenue. The progressive wish list, spending projects, and out-of-control regulations of this administration continues to eat away at American paychecks. And they continue to blame, whether it's shrinkflation, greedflation, skipflation. They're looking for someone to blame except for Bidenflation. The devastation of Joe Biden's economic policy continues to impact everyday Americans. The American people see through the facades and they want real solutions. It doesn't take a PhD economist to understand what the average American is experiencing under this administration. When President Biden and my Democratic colleagues pump trillions of dollars into our economy, those dollars increase the demand and pushes prices higher. It's that simple. The American people see and feel it every single time. And they see it, as I said earlier, the grocery stores, the gas stations, at the doctor's office. It's just undeniable the impact that this is happening. Just last week, we celebrated the birth of our country, the birth of this notion of freedom and liberty. But American families got slapped with the most expensive July 4th on record, with a cookout this year costing, on average, 30% more than it did just a few years ago. I call that hogwash. What's worse is that this administration doesn't want to learn a lesson in economics.
This guy writing his own
of
speeches.
reducing the push for more spending and more regulations, they only
Who the fuck
simply
says
double down.
hogwash?
Let's take, for example, the tens of billions of dollars of student loan forgiveness. Constant new plans to forgive more money, regardless of the constitutionality of their decisions. So it's important to ask, who are these billions of dollars of forgiveness actually benefiting? Well, the answer is simple. This forgiveness scheme will result in debt relief for 750,000 individuals.
Harry
from households with
Potternomics.
an average income of 300,000 or more. And just don't forget the fact that the average American family has a household income around $74,000. So what we're doing with this unconstitutional student loan forgiveness is actually asking the median household of $74,000 per household to bear the burden of forgiving debt for students who live in households of over $300,000. And the actual cost of this, somewhere between $870 billion and $1.4 trillion. So why do I have to even ask the question? Why do we continue to punish American families struggling paycheck to paycheck with a new scheme to relieve households over $300,000 of student loan debt? Well, the answer is pretty simple. Politics. It's one way to buy vote after vote after vote for November's election. It's just hard to imagine. So while I appreciate your measured words outlining the Fed's work to cool inflation, I think it's past time we all recognize what is truly going on: political pandering from the left. I strongly believe that our economy cannot handle any more of this wasteful spending. And if you disagree, I would love to hear your thoughts on that. But it's not just spending policies that stifle growth, it's also overregulation. And I can't think of a better example of overregulation than parking more capital on the sidelines through Basel III Endgame. That proposal itself would cost millions of Americans their chance to own a home, start a small business, and have access to the credit and the capital necessary to make their American dreams come true. For those who are actually watching this hearing today on C-SPAN, Basel III capital requirements are like taking your star quarterback, Dak Prescott, and telling him to sit on the sidelines because he just might get injured during the season. It's just plain ridiculous. But these proposed capital requirements would just do that, forcing more money to the sidelines of the greatest economy on the planet and out of the hands of first-time home buyers, business owners, and folks trying to achieve the American dream. The stakes are high, and that is why we have to get this right. You've heard me say this a number of times, but it bears repeating. We need transparency in your rulemaking process, as this enormous proposal lacks any form of clear justification. Chairman Powell, it is essential that you and your fellow governors and the other agencies join in this rulemaking, follow the law, do the homework, and then let the public check the work. And that's why I believe that it is absolutely necessary to have a complete re-proposal of Basel III Endgame. Give the stakeholders
Won't someone
an
think of the
opportunity
children?
to take a look at it and then recalibrate.
The irony
what
of this
necessary
is
going
that
forward. Any increases in
increased
capital
bank
that are
deposits
not
would force
quantitatively
banks to
justified
loan
harm
more,
the American people who need it most.
right? Because they wouldn't be able to
Farmers,
rely on speculative
home buyers,
gains
small business
as
owners
much, and so they
need
would
and
actually
deserve
be
access to credit.
looking to lend
Therefore,
more money
I'll repeat it one more
at
time.
lower rates.
You need to restore confidence in this rulemaking process, pull the existing proposal, and have a complete restart. And then, when the data has been analyzed and is available for the public scrutiny, reissue an appropriate proposed rule following
He could just come out and say
requirements
he
of the
really needs rates
APA.
lower. They're all
Look
going to say
forward
that.
to your opening statement and having a chance to have the conversation afterwards.
The only thing that matters today is that the
Chair,
Fed
welcome.
is
Thank
now
you for your
allowed to sell
service
the
and for
top
your
again.
testimony today. Please proceed.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people. Over the past 2 years, the economy has made considerable progress toward the Fed's 2% inflation goal, and labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that the U.S. economy continues to expand at a solid pace. Gross domestic product growth appears to have moderated in the first half of this year, following impressive strength in the second half of last year. Private domestic demand remains robust, however, with slower but still solid increases in consumer spending. We have also seen moderate growth in capital spending and a pickup in residential investment so far this year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, a broad set of indicators suggests that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated. The unemployment rate has moved higher, but was still low, still at a low level of 4.1% in June. Payroll gains averaged 222,000 per month in the first half of the year. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in labor force participation among individuals aged 25 to 54, so-called workers in their prime working years, and a strong pace of immigration. As a result, the jobs-to-workers gap is well down from its peak and now stands just a bit above its 2019 pre-pandemic level. Nominal wage growth has eased over the past year. The strong labor market has helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past couple of years, but remains above the Federal Open Market Committee's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.6% over the 12 months ending in May. Core PCE prices, which exclude the volatile food and energy categories, also increased 2.6%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee has maintained the target range for the federal funds rate at 5.25% to 5.5% since last July,
Delta goes negative
after having
at
tightened the stance of monetary
55.80.
policy significantly over the previous year and a half. We've also continued to reduce our securities holdings. At our May meeting, we decided to slow the pace of balance sheet runoff starting in June, consistent with the plans released previously. A restrictive monetary policy stance is helping to bring demand and supply conditions into better balance and to put downward pressure on inflation. The committee has stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. Incoming data for the first quarter of this year did not support such greater confidence. The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated
Short-term
inflation is
support
not
on
the only risk we face.
SPX.
Reducing policy
Locally,
restraint too late or too little
55.80.
could unduly weaken economic
Major
activity
support
and
at
employment. In
55.50.
considering adjustments to the target range for the federal funds rate, the committee will
But
continue
80,
its practice
80
of
and
carefully assessing
75 are going to
incoming
be
data
pretty
and their
important on the
implications
downside
for the
move here.
evolving outlook, the balance of risks, and the appropriate path of monetary policy. Congress has entrusted the Federal Reserve with operational independence that is needed to take a longer-term perspective in the pursuit of our dual mandate of maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on those goals matters to all Americans. I'll conclude by emphasizing that we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Thank you, Mr. Chair. And the senior member of the committee will begin the questioning. Senator Reed.
Thank you very much, Mr. Chairman. Former President Trump has indicated that he would propose, if elected, a substantial increase in tariffs of between 10 and 60%, and by doing thus, eliminate the federal income tax. First, on the question of what would be the impact of tariff increases on businesses, consumers, and the economy?
Thank you, Senator Reed. So I'm going to say that we go very far out of our way not to comment on campaign-type information. We just don't do that. We also don't comment on trade policy. We have really specific and important jobs, and we try to stick to those.
Well, I'm glad I allowed you to establish that principle up front, Mr. Chairman. But let me opine a bit. 10%.
How does he say
increases in
stable
tariffs
prices
is
with a
gonna have an
straight
effect on
face?
prices at the shop aisle. It's going to
They do
increase.
try.
It'll be passed on like.
I mean, he just gets to read the document, right? That's all he really has to do
And in
here.
fact, I've been told that to replace the income tax, you would have to raise tariffs across the board 70% to make up for the loss of the income tax, which would, I think, create huge economic problems. I respect your impartiality and your neutrality, but the numbers don't seem to add up to anything that would help the country. Let me switch to something else that might be more within your line of response. You said in your opening statement that labor markets appear to be in a better balance. And that's one of the key factors to judge whether interest rates can be raised. I must say I'm concerned a bit that we're not on a very faster track to decreasing interest rates from the Fed. And because of the better balance you cite. Could you comment on that, Mr. Chairman?
Sure. So the most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy. This is an economy, as I mentioned in my opening
Forex is
remarks,
doing
that's
some
more or
stuff.
less
Yeah.
back by most measures to where it was.
Yields
before the
moved up a
pandemic.
bit.
And that was a strong labor
I think
market.
I
It
think
was
they
not
were
an
hoping
overheated
for
labor
a
market.
stronger
So I think
stronger
the
take on
upshot
the
of that
recent inflation
really is
data, right?
That we're well aware that we now face two-sided risks and have for some time. But now, the labor market appears to be fully back in balance. We know that if we move too quickly, we risk unnecessarily hampering economic activity and possibly interfering with the ongoing expansion. We know that if we move too slowly, that we may undo the good we've done. Well, actually, it's the other way. If we loosen
He doesn't even know
policy
how it works.
too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very much balancing those two risks, and that's really the essence of what we're thinking about these days.
But the direction seems to be going towards lowering interest rates at some point, we would hope. That might be a wish rather than a direction.
But I think if you look at the last summary of economic projections, I guess I would say it this way. It doesn't seem likely that the next policy move would be a rate increase. We don't take things like that off the table, but that does not seem the likely direction. The likely direction does seem to be as we make more progress in inflation and as the labor market remains strong, we begin to loosen policy at the right
Is
moment.
that dude a Sith Lord? No, he's the great-great-grandson of Colonel Sanders.
2 weeks ago, the Supreme Court handed down 2 decisions that impact every federal regulatory agency, including the Federal Reserve. They overturned the Chevron case, which had eliminated judicial deference to agency decision-making for many, many decades. And they also dramatically extended the statute of limitations under the Administrative Procedure Act. What is your judgment is the cumulative effect of these decisions on the Federal Reserve? More broadly, what does it mean to the economy if virtually any regulatory decision the Fed makes can be second-guessed by a judge? What position are we in now?
So we're as an institution very focused on
Delta
reading
stayed
the actual
negative on the
letter and intent
bounce.
of the law and following it carefully. This is a strong institutional value that we have. Those are brand new decisions that just came down, and we're really in the process of just studying some. I don't have anything for you on them, but we will of course follow the law as the Supreme Court as the Supreme Court has read it, because that's their job.
Well, thank you, and I concur with compliance with the law, but when you do your analysis, and if it is detrimental to your ability to regulate the banking industry in the United States, I think you have an obligation to make that public. Thank you, Mr. Chairman.
Thank you, Senator Reed. Senator Scott from South Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, we've heard a steady stream of commentary that there will be changes to Basel III endgame proposal. That can be seen certainly as good news. Some reports say it could be finalized as soon as August. Others say you are circulating a term sheet for a revised proposal. Through it all, this proposal will have outsized impacts on our banking system, from big to regional
downside
to our
continuation.
U.S.-based foreign institutions, as well as impeding access to credit for consumers. So even though you yourself have said there will be broad and material changes. I believe this proposal is flawed, both in process and in substance, and should be withdrawn. Do you agree, and will you commit to withdrawing the existing proposal and issuing a new proposal with a robust notice and comment process?
Well, let me update everyone on the
Please.
status of all that. So over the past several months, we've had, in fact, Vice Chair for Supervision Barr has held a series of discussions with the other bank regulatory agencies around potential changes to the original proposal. I'm pleased to say that we've made quite a bit of progress on those and are very close to agreeing on the substance of those changes. And I can't really be specific because nothing is agreed until everything's agreed, so I won't have a lot of specifics for you today. The question where we're continuing to try to make progress is that of process. So it is my view, it is the strongly held view of members of the board that we do need to put
Bulls are stepping in
a
to
revised
defend
proposal out for
75
comment
really
for some
hard.
period. And the reason is, when there are broad and material changes.
We do have
that has
just
been
a
our
touch of
practice. We don't
negative
see a reason
delta
to
here.
deviate from that practice. It seems to
Charm's a
be
little negative. It
consistent
doesn't
with past
matter yet,
practice and
but
with-
it's
with the
negative.
Administrative Procedure Act.
How
So
long
that's
is
very
this?
much
Usually
what
a
we're
few
thinking.
hours.
We're working through
It's usually over by like
that,
I think
that
1 or
question
2
with,
o'clock,
with
something
the
like that.
FDIC and the OCC. We haven't reached agreement on that, but I'm very hopeful that
Yes,
we
it's
will.
not
We're
looking
prepared to
great.
move forward at that when we do reach
It looks
agreement on that.
fine.
Well, I appreciate most of your response there. I do want to discuss one aspect more of Basel before we move on to another topic. I find it very concerning with how much of this proposal, this process appears to have been done behind closed
Loss at
doors.
25
The Fed, the FDIC,
would be a
OCC
little
proposed
bearish.
Basel III endgame last July. Then in October,
But I would say
the Fed began the collection of
5610
data to conduct a quantitative
a
impact
breakdown.
study on the cost of Basel III proposal. A study which I will note should have been conducted before any proposal was ever issued. Move forward to January of this year, Vice Chair Barr committed to a public comment period once results of the study were published. We are still waiting to view the results. Keep in mind, all the while, we're hearing rumors that the Fed is working on revising its proposal and moving towards an updated version. Please help me understand, how will the Fed revise or reissue a capital proposal before receiving public comments? Basically my question.
Well, as you know, we have received extensive public comments, and we've also evaluated the quantitative impact survey that you mentioned.
Yes.
And so the idea would be when we
OEV
when we do
is
reach
far too
agreement with
close
the
to
other agencies
250
fully,
there
that we would
for a
publish.
second. Good job, Shorts.
The
You
proposed
stopped it for
changes and
now.
also the
we'll see.
quantitative impact survey.
1 second.
And also the effects that the QIS suggests that the changes would have. So we'll put all that out for comment again for a period of time. And then, having had yet another round of comment, and we can then move toward finalizing. That's basically the broad strokes of how I would see this moving forward.
And how long do you see that opportunity for public comments?
So it would be meaningful. I mean, it might be 60 days. We don't need to it doesn't need to be a long one. But, before we do that, there's a lot of work that needs to take place, before you actually put out the revised proposal. Quite a bit of work. So it will take some time, and then we would put it out, and then there would be, I'm just taking that number, 60 days of comment, and then we would get the comments back, and there would be another period of evaluating the comments, and only then would you go final. So there are a number of steps here.
Yeah, thank you. Well, just final point as I'm running out of time here. I think Senator Reid made the comment about the Chevron case and the impact that it could have, certainly in curtailing, from my perspective, the regulatory state. The necessity of a cost-benefit analysis on new regulations that will impact the economy, I think, is quite helpful. In the 1,000-plus pages of Basel III, I think there were about 20 pages that reflected some kind of cost-benefit analysis approach. I really hope that we see more of that going forward.
Thank you.
Senator Tester from Montana is recognized.
Well, thank you, Mr. Chairman. Thank you for the courtesy. Chairman Powell, good to see you here today. Appreciate your work. Look, regardless of where I go in the state of Montana, housing is a big issue, whether it's Billings or Butte or Bozeman or Busby or Big Sandy, it doesn't matter. larger towns to medium.
How's housing an issue? There's nothing there.
Housing is a huge issue. And I think it's a huge issue all over the country, and correct me if I'm not correct in that. And I was wondering how the housing challenges fit into the overall economic picture. that
Dodge,
you're
duck,
seeing.
dodge. Professional boxing.
So we do pay a lot of attention, and I would agree with you. We have significant housing issues in the country,
Don't
and we
lie
had
to
them
him. No one's
before the pandemic.
paying attention
Certainly,
to
the
housing on
the
Montana.
pandemic has created new distortions, and you know, monetary policy works through interest-sensitive spending. There is no more interest-sensitive
hundreds
spending
of people,
than
Gherkin.
buying a house and having a mortgage. So, for sure, our tighter policy is having an effect on economic activity. in the
Hundreds of
housing
people
sector.
with an outsized amount of
But I would also say
electoral
the
votes.
best thing we can do for housing is to succeed in getting inflation down to 2% on a sustainable basis so that rates can come down, so that the housing market can get back to what was the pre-pandemic normal, which is to say, still a housing shortage, but not dealing with the kinds of specific things we're dealing with now.
So let me drill down a little bit. I'm speaking not necessarily from a housing cost.
Jackson's Holes in
perspective
Wyoming.
on the things you just brought up. I'm speaking more from a standpoint of economic growth, in that there are plenty of small businesses, schools, hospitals, Main Street businesses that can't hire people, they can't expand because there simply is no place for them to live. How does that fit into?
Speaking
the
like a
economic
true
outlook
coastal elite,
metrics?
it's better than taking the opinion of some mud
Because I
dweller.
think it's, from my
living-
perspective,
living under a
it's- I think
cow
it's
in
limiting
Montana
the
'cause there's no
opportunity for
housing.
Expansion, it's limiting the opportunity for entrepreneurs, business startups. And does that fit into the economic?
Moo.
picture that you're-
So our mandate is for stable prices and maximum employment. And again, I think for housing supply, the best thing we can do is get inflation under control so that rates can come back down, so that we can have a more normalized set of rates and a more normalized housing system. But I think policies to increase housing supply are really not so much in the hands of the Fed, they're in the hands of legislatures, you know, state and federal.
Do you believe that if we were to put forth some housing incentives, whatever they may be, that could have if those incentives resulted in more affordable workforce housing on the market, that would have
Just build more
positive impacts on the
houses.
economy?
It's so
You know,
easy.
these are questions for you, but I would say this, that I'm aware that housing is in short supply, and that
Fix
for
it.
many, it's a critical need for the workforce.
Okay.
And so more of it is better, but as to where the fiscal policy how you should prioritize that, that's not up to us.
Look, I want to talk about the
Find a
independence of the
rich
Fed
neighborhood
because I know
and
that
build
you
like
are
1,000
strong
homes in it.
supporter of independence, as am I, and
Perfect
political
solution.
influence I don't think helps with monetary policy in the country, and so give me your perspective at least on why the central bank independence is so critically important.
Thank you. I'd be glad to. So essentially, all advanced economies have adopted a policy of central bank and operational independence, and that just means that
We're gonna be
we make our
neighbors.
decisions. We're instructed to make them without taking in extraneous factors, one of which would be politics. And the record is pretty clear that that's a good it's a good institutional arrangement that serves the public well. And you know, we just want to stress, as we do periodically, that this is an institutional choice that we make as a country, and that as long as it's seen to serve the public well, it's a good choice. We think
It's
so.
in short supply because major
on
corporations are
advanced
buying them
economy,
faster than the
there's
normal
some that
family can
talk
get to
about
them. I mean, that hasn't been
not
true
being
since
in
like
very good shape. From
2021.
your perspective,
Hedge funds have been selling
Tell me
off
how the
their,
economy
and
of
like
this
private
country is doing
asset
compared to
managers have
other
been
advanced
selling off their
economies that
real
have
estate
central
holdings.
banks.
They just can't dump them all at once.
So I'm in lots and lots of international
But you just build
discussions as part
faster
of my
than they can
job,
buy.
And the
It's
story
easy.
for the last 2 years has been just how exceptional the performance of the U.S.
You build
economy
and they
has been.
buy, and then you build
that's
more,
not a secret. You know,
and they buy a
there's
little
there-
less, and then you build even
Clearly,
more.
the U.S. economy has performed very well compared to sort of our advanced economy.
You could buy a
is
house in
there any
upstate
country
New
in the
York for
world
like
with a
$5
central
grand.
bank in the advanced economy that's
It's an
performing
old
better?
piece of shit in the
There's a
Rust
central
Belt,
bank?
but it's still
No,
$5,000.
Any economy that's an advanced economy that has a central bank that performs better than us?
None comes to mind. As I think of the majors, the answer would be no.
Okay, thank you.
Thanks, Senator Tester. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. Mr. Chairman, first of all, thanks for coming in again and visiting
Think
with
of
us.
the home builders and their
I just wanna
profits.
focus on
Fuck
two
'em.
specific items, and I'm going to start with the Basel III endgame discussion. I think Senator Scott.
That's all we need to do. It's really
kinda
easy
laying
to
out
shift the
concerns that
direction
many
of
of us have
our
had with it.
of all our policy. Instead
I
of
would like to
worrying
go back
about
into
small
the issues,
businesses,
I think
large
a lot of folks out there
businesses,
that follow this, and
just
I
worry
know
about
it's
just
technical
do
in
just
nature,
do the
but
things that
let me
hurt
just ask a
them instead of the
specific
things that
question,
hurt
and
poor
you can kind of
people.
pick it apart for me, please. Both you and Vice Chair Barr have confirmed that there will be material changes to every
What is the
aspect
quality of
of
that
the
house for
proposal.
5K? I'll tell you one thing, it
Since
was
there will be
really
significant
really
changes,
nice in
do you
1920.
believe where the agencies have landed now would be considered a logical outgrowth of the original proposal from last summer?
Some of them are
For
livable.
those people who are
I
not
mean,
familiar with, that's the legal test.
depending on
for
how
what
you
that
feel
turns out
about
to
lead
be. If it's
paint.
a logical outgrowth. If it's not a logical outgrowth, that would require legal.
I'm gonna start
require
taking a shot every
reproposal.
time they mention
And I don't want to make a legal
Basel.
judgment. I will just say again, from my
I'll be
standpoint,
dead
my
soon.
view and strongly held view of some
Don't
of my
do that.
colleagues on the board
That's-
is
that's
that it will
risky.
be appropriate for us to put out.
You guys
the
don't. You
changes
just.
again
You
for
know
a
what? You
period of
guys just don't
comment.
get it because
Just
you're the
because
unwashed
it's the right thing to
masses,
do. It's what
right?
we would do
The
typically in a
banks need to
situation where there are,
gamble more
material changes to
so
a
that they
proposal.
can continue
Do you
to
feel that you have a consensus
support
on the board
growth
to allow that to move forward?
of small businesses and ensure that Americans.
Yes, but of course
Are
we have
able to
get
buy
the-
homes.
The FDIC and the OCC.
If the banks
we're-
don't gamble, they
in
can't
discussions
just
with
lend
them to
money
work- to work
for
on
30
something that
years
would
and
meet
collect
that need,
interest.
And we have to get their agreement too.
Why does nobody think about the bank's
Sounds like
short-term
that's the path that you would
returns?
like to go down.
Yes.
Think of their
If
bonuses.
that were the case, would it be fair to say that we'd probably be
I'm sure
looking
the
at
banks
final determination and
stop.
recommendations for a Basel III endgame proposal probably
Borrow short, lend long.
become any sort of final
Boring.
determination.
I think that may be right. It's
I kind of want to short the bank earnings this
something
week.
like that could be right. Yeah. I mean, it's you can't be. It's hard to be precise. We would put it out. It takes some time to write this stuff up. Then you put it out for comment. Then you get the comments. Then you read the comments. Then you write the final rule. Beginning part of next year is a good guesstimate.
The only reason why I push is because there are so many folks directly involved with this and the impact on our economy here and with a lot of our financial institutions. This is a significant change, and it's one that a lot of people are following. So I'm trying to get you to get into the depth of this as much as possible, and I thank you for that.
Get fucked.
I
Hog
also
tie
wanna
their
go to one other
liquidity.
area, and once again, this is something that you and I have had visits
Fuck
about
them.
in front of this group before, but I want to talk about what the parts of inflation are and what parts you can control and what parts, as the Fed, you really can't control. The demand side
You
of the
can't buy
equation
puts in a
on
checking
inflation
account.
is the part that you have the tools to work with. But there is the supply side of the equation, which is still out there. And I want to just lay this out because as we do this in this setting, it naturally becomes political in nature because the
Those
one
would
of
be
the
settled out by a clearinghouse and
starting
have
points
nothing to
we
do with
talk
your
about
bank.
is when this administration
But
took
you,
office
you,
and
you
what
can't
happened
you
to the
can't you
supply
can't
side
buy
issues at that
puts in
time.
a
And as
like
I
a
work my
checking
way
or
through
savings
this, I just
account.
want to share
You can only
the
buy them in a
concern that I've
brokerage
got, and then
account.
I recognize you don't want to be political.
There's a
but I
reason
wanna
like
lay this
brokers
out,
are
and then I wanna
considered
talk about what you can
safer than
control and what you
banks
can't
in the
control
event of
with
like
regard to making
large
changes on inflation
large scale bank
through the
failures, and that's
processes that we
because
have.
brokers can't take your
When
money
President Biden
and
took
invest
office,
it in other
gasoline
shit.
prices,
Only banks
since
can do
President
that.
Biden took office, gasoline prices have risen.
That's why the
over
data on
54%.
like Charles
Energy
Schwab
prices
is
have
like kind of
risen
inaccurate.
41%. Fuel oil prices have risen 37%. Now, I can go on, but
They're
you understand
separate.
What I'm saying is that energy has increased substantially. And I think one of the reasons for this has been additional demand. as
Rest
we've
in
come out of the
peace,
pandemic.
Glass-Steagall, you
But the
mean?
other part of this has been whether or not investors really want to go back in and invest in traditional energy resources after the president made the specific determination to cancel the Keystone XL pipeline on the day that he stepped into office. When he did that, he sent one heck of a message to investors about traditional energy and investing in traditional energy in the United States, and the fact that a multi-billion-dollar contract or contract could be canceled with the stroke of a pen. Now, my question to you is, what percent, or has there been a discussion about what percent or what amount of the inflation that we've seen over 20% increase in terms of affordability for a lot of our products. How much of that is attributable to the demand side, and how much of it really is attributable to supply side challenges that we've seen in this country?
It's, that's a question that we've thought about a lot, and any attempt to reduce that to a precise number would be inappropriate because it's so uncertain. But I think we can say, I believe strongly, there's a significant demand element and there's a significant supply element. And we've seen the supply side heal so much over the course of the last year or so, and we clearly see that that's contributing to lower inflation. We also see cooling demand, for example, in the labor market. So the two forces are working together. I can't really break it down. It would be such an imprecise estimate. I'd
Just
hate to
simply
say.
just simply an acknowledgement, though, that it is both demand.
It's both. It's definitely
and
both.
it is supply.
It is both, yeah,
Thank
for
you.
sure.
Thank you, Mr. Chairman. My time has expired.
Has risen by 0.5 percentage point over the past year. The number of job openings has dropped almost 50%. The hiring and quit rates are now below pre-pandemic levels. I'm concerned that if the Fed waits too long to lower rates, the Fed could undo the progress we've made on creating good paying jobs. Full employment is part of the mandate, as you say over and over. How are you assessing the risks of higher interest rates in the labor market?
So I completely agree with your characterization. The latest data do show that we've had considerable cooling in the labor market, and we're very
No,
much
they're just
aware
insured
that there are two
separately,
sides
and the
risks
money
now,
in
as I
them is
mentioned,
managed
earlier.
differently.
And we're determined to balance those as
I mean,
best
if
we
you have
can.
less than
We wanna
250
see
grand
more
in
good
your checking
inflation data,
account, it's not even
and we also
something
want
you
to
need to
continue
worry
to see a
about,
strong
right?
labor market. And we those two things are equal under the law. We have this challenging thing to balance them, but we're very much conscious that that is our job, and we're trying to do that.
Well, and you know that if unemployment trends upward, you must act immediately to protect Americans' jobs.
Do these people not
Workers have
understand
too
what
much to
happens
lose
if
the
rates
Fed
are cut?
overshoots
No, they
inflation
absolutely
target
do.
and causes
But
a
then it won't be
completely
the bank's
unnecessary
fault.
recession. We will say that over and over and over again. I think you understand
And then the
that.
banks can be like, look what the Fed did to
Higher
us, and
interest
get
rates
bailed
are making
out.
housing more unaffordable. Higher rates are supposed to lower cost, yet housing prices continue to soar. By keeping rates high,
think
the
he had,
Fed
like,
ignores
throat
the economic
cancer or
reality of the
something.
millions of Americans struggling to make ends meet and get ahead. Let me ask you 3 quick yes or no questions, if you would answer that way. Since late 2022, when the Fed began raising rates, has the volume of housing sales decreased?
I believe it has, yes.
Since late 2022, has the median home price increased?
I believe it has.
Since late 2022, have monthly mortgage payments become more affordable or less affordable for home buyers?
Less affordable.
Okay, thank you. In short, despite housing sales declining, the median price for a single-family home has increased by nearly $20,000. People are spending a greater share of their income in mortgage payments, so in some higher rates, it's clear from your answers and data, it's clear higher rates are not bringing down housing costs. The cost of home ownership is only going up. Let me shift to the synopsis. Bankruptcy. Since mid-May, tens of thousands of people, including many Ohioans, have lost access to their money due to the bankruptcy of this fintech middleman. Reports indicate that as much as $95 million may have gone missing. The Fed oversees one of Synopsys' former partner banks, Evolve Bank and Trust. As a regulator, it's your job to make sure that banks protect the people whom they serve. What's the Fed doing to help customers who felt the impact by the Synopsys collapse? What are you doing to regain access to their money?
So we do supervise the bank. We don't supervise Synapse, or let alone the fintechs that feed into Synapse. And we're strongly encouraging Evolve to do whatever it can to help make money available to those depositors. We also, as you may know, did an enforcement action against, before this all happened, we did an inspection or looked at Evolve, and we.
What's with this
we hit them
obsession
with
of buying a home? It's what the
enforcement action around
entire
these very risk
American
management
economy
issues,
is built on.
Again, before the current situation developed.
Okay, it's critical that consumers are made whole as soon as possible.
If we
will
get
continue to
rid
talk
of
to you about
home
that.
ownership, we have
watch.
to
will
admit
let you
that
know
we
we're
no longer
watching.
have a middle
The Fed needs
class.
to use its supervisory authority to ensure that Evolve is committing the resources necessary to return those funds to the account holders. Last comment, I want to note one last thing. Last year's Fed report on the failure of Silicon Valley Bank, noted how incentive-based compensation encouraged excessive risk-taking that led to the
What
bank's failure.
happens to the 30-year?
You either watched or had reports of when those bank CEOs testified in front of this committee.
What's the middle class?
The report, the incentive-based compensation that led to the bank's
Slightly
failure, I
less
mentioned, it said
poor.
that SVB managers, quote, had a financial incentive to focus on short-term profit
Currently, a family
over
that
sound
spends
risk management.
65% of
That's
its
what a
income
number
on
of
its
us, Senator
mortgage.
Smith, Senator Butler, Senator Warren, Warner and I have said over and over that that short-term profit over sound risk management causes significant problems to our financial system. Compensation practices still pose a threat to our banking system. I urge you to move quickly to join your colleagues in the long overdue rulemaking on executive compensation. I mean, you read the reports at the outrage of the public about executive compensation continuing to go up and up and up and up. You have a role, a significant role, a legal role to deal with that. Thank you. Senator Tillis is recognized.
Thank you, Mr. Chairman. Thank you for being here. I want to be real quick on Basel III Endgame, and I want to be mindful of time. Just simply, can I get a commitment from you on releasing the results of the QIS?
Yeah, we plan to release the results of the QIS.
What
not
timeframe?
just Well, first we have to get agreement with the other banking agencies, but as soon as possible.
Can you imagine any agencies having a concern with, any other banking agencies having a concern with releasing it? Or is it just a matter of
Not at
pro
all.
forma? Okay.
No, it's just a matter of the bigger picture of getting agreement on the revisions to Basel III and also how to proceed.
That's great, and I really appreciate the feedback that I've received from you. I should have started by thanking you again for your continued accessibility and discussions outside of the committee. They're very productive, and I appreciate that and your leadership at the Fed. I grew up in the 70s. Got my Social Security number in 1973 when I was 12 years old. That's when I made my first payment. So I've been following the economy even as a youngster. And that was a really lousy time to enter in the workforce. Tell me, and I'm hearing discussions among some of our members now that would almost be reminiscent of discussions with prior Fed members saying, look, we got to lower interest rates and we've got unemployment out of control. So it sounds like we're taking some suggestions from some of my colleagues or plays from a playbook that didn't prove to be very effective back in the 70s. What can we learn? I'm not going to ask you about where you go from here, but if we look back into a postmortem on some of the decisions that were made when we had consistently high inflation, we had consistently high unemployment, what lessons can we learn there, or what mistakes should we not necessarily repeat? And I know that this is a fingerprint of a challenge. It's not exactly like the stressors that we had back in the 70s, but what can we learn from the decisions, what I think are arguably the wrong decisions made back then when we were dealing with high unemployment and high inflation? What did we learn?
I think the number one thing we
Did
learned
anybody
was
find it
that it's
really
up to the
interesting
central
that
bank to take
the
it on
S&P
and stick with it
outperformed
until
the
it's done.
QQQ on that
And
bounce?
that doesn't sound controversial now, but it actually was back then. And so people didn't really get in there and get it done, and inflation kept coming back. I also think there were significant differences this time to the questions a minute ago. This is a combination of a supply side that we had very significant supply shocks along with big demand shocks from the reopening of the economy and from
Must
all
be
the other
getting a
things that happened.
breakdown and
I think
dispersion.
we have to.
Yeah, we
each one
are.
of these things is different in its own way. We try to learn the lessons of history, though.
You agree or disagree? Any disconnect between inflation and inflation expectations from the 2% target should be addressed now and not at a later time?
Absolutely.
I like that answer. I want to go to something different. I'm trying to go into a lightning round now and finish on time. We've seen the 2024 stress test results for the U.S. banking system. It looks like to me, by every objective measure, we've got a banking system that's on strong financial footing. Do you agree?
Yes.
one last thing, as the Fed considers making broad and material changes to the Basel III proposal, back on that one, can I urge you not to overlook the second-order issues important to FBOs and certain regionals to ensure that the banks are not unduly influenced? If the current proposal, for example, the
Just say the
outsized
truth.
operational risk costs were high, are we going to take care of that in any sort of reproposal?
Let me just say, we're very conscious of the comments across the spectrum, foreign banks, domestic banks, small, medium-sized banks. You know, everyone's going to get heard carefully as part of this process. That is our obligation.
And I think in response to Senator Round's question, you did indicate there's probably, because of the nature of the likely changes from what Mr. Barr expected to what may ultimately come, we are going to open it up to comment again.
That's the strong view of the Federal Reserve. We're working on that question with the FDIC and the OCC to try to find a path to do that. But
Very good.
From our standpoint, that's essential.
I think it's a strong view from at least several members on this side of the dais here. That would be very, very important, because I think it's going to materially change. Thank you, Mr. Chair.
Thanks, Senator Tillis. Senator Warner of Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again, coming this late in the questioning. I'm going to at least hit a couple of the items that my colleagues have otherwise already hit, because I make sure it's noted that I raised them as well. First of all, I want to agree with the chairman. You know, I probably hear more on housing and housing affordability than any other issue, and I agree with the chairman. And I know we've discussed this around a rate cut, and I understand most of your answer, but I still want to add my 2 cents here. We've got to find a way to start bringing mortgage rates down and let people get unlock that housing market. And again, we've discussed the rate cut issue, and I know you've got to navigate that, but I hope it's sooner than later. I will not recap what I've done in the last couple hearings with you, but I do think the discount window proposal that I've gotten, that I know you're working on, you know, before we think about additional regulations, and we do need in some cases, I think the discount window is an underused tool, was one of the original tools for the Fed. A lot of my colleagues have talked about
Why the fuck would you use the discount window when you can get money from Japan
I do hope
at
when we get the
1%?
revisions that we'll see the quantitative analysis that, again, Senator Tillis already raised and other colleagues have raised. I also hope that one of the questions I raised in my March letter to you was, you know, making sure any new regulatory structure, how it intersects with existing regulatory structure and in terms of market risk, credit
Small
risk.
business owners need the discount
Again, hope that
window.
we will have that as the revisions come out.
Yeah, are you guys
I
not?
think
Are you
one
guys
of the
not
things
using
that
this
this,
the federal
debate around
discount
Basel
window
III,
to help fund
raised
short
was
term
that
for
it was my
short term
understanding, at least,
expenditures in your small
looked at-
business?
You may be all looking at revisions to liquidity standards as well, and wanted to see
I'm gonna open a
what
fucking
you would
business
say
in
about that and
Japan.
whether that part of those standards are under review and what your thinking is.
Yeah, and I think that actually connects to the Silicon Valley Bank questions as well, where I think there seems to be a need to update assumptions about liquidity. And that's a separate proposal that we're also working on. And, you know, very important, I think we saw how fast that run was. It was just exponentially faster than prior runs. That's the new world, and you know, that's some estimate of what that world is baked into things like the liquidity coverage ratio, for example.
Right, and wasn't that the case, you know, if you had 25 cents on every depository dollar leave in 6 hours, no matter what the capital standards are.
Yeah.
And one of the things, I guess, you know, there was a lot of talk after SVB that we need to think about internet-driven runs. A lot of us raised concerns. Candidly, I'm not sure I've heard any good proposals, so whether it comes from you guys or from folks listening, how we think about this new internet-driven world. And frankly, I think some of the irresponsible behavior by some
Only
of
had
the
25
folks that were
years to
major
figure that out.
depositors in SVB, who in many ways shouted fire in the crowded theater, and we've not seen any action there. So I would welcome additional ideas as well. And that kind of brings me to my last questions around supervisory reform. I know the GAO criticized the Fed's supervisory procedures in the role they played in the 2023 failures. It is a whole brand new world. Are we going to look at, will your changes to supervisory standards be comprehensive? Will they be one-off? How do you think about that in light of the GAO report and also in light of just the SVB and the few of the other failures we saw last year?
Vice Chair Barr is, who's Vice Chair for Supervision, is leading a process of looking at the way we supervise banks and thinking about how we can be faster where it's appropriate, more forceful where it's appropriate. And I think, they've taken a pretty deep dive and tried to learn these lessons and then implement them in a way that is appropriate. So that's a big project going on at the Fed right now, which really Vice Chair for Supervision leads.
I think I remember lots of conversations with the chairman, with you, with the FDIC, and that Thursday through Sunday. And I think the solution you guys came up with, the administration came up with by Sunday night was a good one, but they were a pretty scary 3 or 4 days there. And it did seem like the process, I don't know completely how you get fully ahead of that, but I firmly believe that there should have been a clearer early warning system and trying to make sure that we wouldn't be in that kind of crisis situation going forward. And again, I would strongly encourage any additional thoughts on this technology risk and how we get that right. Thank you, Mr. Chairman. Thank you.
Takes an order. Senator Kennedy of Louisiana is recognized.
Uh-oh.
Thank you, Mr. Chairman.
Brainworms. Wait, is this brainworms or is it someone else?
Mr. Chairman, our economy is slowing, is it not?
Yes, although still growing at a solid pace.
This is a
Our
brainworms.
unemployment rate is rising, is it not?
How did all
Yes,
the
it is,
Kennedys end
although
up being
the labor
from the
market is still
South?
strong.
Our labor market is slowing, is it not?
Yes, but I'd say unemployment is still, is still low by historical standards. But yes, it is. We've seen cooling. Yes.
And I was looking at the recent jobs numbers. I know you've glanced at them too. About 3/4 of the net new jobs that were created in June were in government, healthcare, and social assistance. What does that tell you?
So that's a concentration. You'd rather see broader job creation than that. Those three areas have, in some reports, they've been, as it was this time, they've been the predominant creators of jobs. That tells you that job creation is becoming less broad in the economy and it's narrowing.
It tells you that government's creating those jobs, doesn't it?
Well, it's government. It's also in-person services. It's also some of it's government.
Manufacturing's been flat.
Yes, manufacturing's not creating a lot of new jobs these days.
Information technology shed jobs over the past 2 years, hasn't it?
I don't know.
Leisure and hospitality jobs have slowed to almost a trickle.
So that's a place where there was a desperate worker shortage, and they've done quite a bit of hiring, but they're catching up now.
I mean, 3/4 of the jobs that are being created in our economy can be related directly or indirectly to our spending deficits, can't they?
In this report, in this single report, I don't know that healthcare is really government spending. I mean, that's something people are consuming.
Where do you think these hospitals get their money?
They may get it, but I mean, people are not. The spending on healthcare is not necessarily directly related to deficits. Is my point.
I would disagree with you. I mean, here's my point.
This isn't
We talk
brainworms.
a lot about
It's just another candidate. Well, unless it's
Expectations in
the
terms of
brainworms are
inflation.
genetic.
how if we expect there to be inflation, we'll get inflation. It seems to me that consumer expectations play a bigger role in the economy than we cede to them. Most of our economy in America is consumer-driven, is it not?
Yes,
Unlike, say, China, which is manufacturing-driven.
very much so.
And I listened to you cite the statistics about the economy, but most Americans don't feel good about the economy, do they?
No, and we don't tell people how to feel about the economy.
I mean, isn't it a fact that most people, if you ask them to define Bidenomics, they would say that's easy. We get to pay more to live worse.
I wouldn't touch a
You don't want to answer that.
sentence with that word in it.
Yeah. Yeah. I mean, we can pretty this up all I guess my point is, and I know you're going to do this anyway, but I'd be really careful with this economy. I mean, people just don't feel better off.
There are a lot of manufacturing plants in a
one
state
can
or
marshal a
something.
persuasive
No,
argument that, well, you should.
Louisiana
compared to Europe,
politicians generally just
or
live off of
compared to
embezzlement.
China.
I thought
Compared to Canada. But they
they have a long history
feelings
of
are feelings. People don't feel
deeply
good about this
entrenched
economy.
corruption.
And it's primarily because of inflation. Let me use my final 30 seconds to ask you. I listened to my good friend, the chairman, give his opening statement. Do you think inflation was caused by corporate greed?
I hate to comment on something the chairman was speaking about.
Or
but-
go ahead?
Well, so I will just say, we see at the Fed, we see inflation as when there's an imbalance between supply and demand. And we use our tools to work on the demand
Am I
side
the
of that
only
and bring
one
it back
old
into
enough
line
here
with
to have
supply.
learned about Huey
I got
P.
2
Long?
seconds. So when are you going to lower interest rates?
I'm today not going to be sending any signals about the timing of any future actions.
Thank you, Mr. Chairman.
Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. Welcome, Chair Powell. It's good to see you again. I want to follow up on kind of the line of questioning that Senator Tester was on a bit ago. He was talking about how the U.S. economy has been outperforming other advanced economies around the world in terms of growth rates, in terms of unemployment, in terms of inflation, getting inflation under control, though I think we obviously can all agree
Delta's
that we're
pretty
not,
positive here.
at least from my perspective, we're not done yet, and we don't want to
We'll
rest
stay
on our
positive
laurels.
unless
But
we
I'm
fall
wondering
under
if you
80.
could share what you think that we have learned from this experience. What have we done right, and why is it that we are doing better than some of the other advanced economies in the world?
Because we
I
exported
think that
all our
it's down
inflation
to the
to
fundamental
them.
strengths of our economy. So, as you may know, European economic officials are very, very focused on this question. They really, it comes up in all of our discussions. Europe has seen productivity increases of about 1% a year for 40 years. We've seen 2%. If you take a number and compound it at 1%, then compound it at 2%, the difference is just enormous after 40 years in terms of incomes and living standards. And their question is, why is that? Why is that? And the standard answer that Americans tend to give, and that I would give, is it's down to, more flexible labor markets. They, in the pandemic, people they stayed in their existing jobs. In the United States, we had people changing jobs at record levels, and that's the kind of thing that adds to productivity and it contributes to rising living standards, going back to school, getting skills, and things like that.
Our living
Another one
standards
is
are
our
lower than
financial sector.
Europe's.
We don't just have banks, we have a highly
Because that
developed,
1%,
ecosystem
actually both of our
financing sources
percents
that will
of
fund early-stage
productivity
investments. Banks
just
are really not
goes
set up to do
straight
that.
to
They're
corporate
prudentially regulated.
leadership.
And so those are some of the things. And I think we just have these natural strengths as as an innovative, more flexible economy. We can grow faster.
I appreciate that. I think sometimes there's a tendency to sort of trash our economy and to sort of say, oh, we suck. And actually, I think that there's great resilience in our economy. I would argue that it has also to do a lot with the incredible resilience of our workers and their creativity and their talent and the training and the education that they have. And I think I would also argue, though I wouldn't
Someone's up
expect
for
you to make this
re-election.
case, that the way in which our federal government responded to the pandemic in order to make sure that people weren't evicted, that they still had money to pay their bills even when they weren't able to work, meant that overall our economy, survived and was ready to kind of be off to the races when we emerged from the pandemic. But Chair Powell, I'd like to ask you a question, something that you and I have talked about, I continue to be thinking a lot about, which is the commercial real estate risk that we have in this country. I think particularly for office space. We know that that has been under strain the last several years. The sector has remained largely stable, but we are hearing about some additional default risk. And one thing that I'm noting is that there's some expectation or concern that may fall disproportionately on smaller banks. I think that commercial and regional banks hold an estimated 2/3 of all the commercial real estate loans in the country. And so unlike larger banks, these
How hard are
smaller
we defending
institutions might find it a little harder
5580?
to deal with this. So could you discuss
see.
this
This
with
is-
us?
this
Could
is
you
right
tell
about
us a
where
little bit
Delta
about how you
turns
see this
negative,
risk?
so
And
Bulls will either
particularly
come in
whether this
here and
poses some
defend it,
additional
or we're gonna get like a little
risk
dip.
that we might be seeing more concentration in the banking sector as these smaller banks are maybe under more pressure.
Yes, so this, to your point, this is a risk that has been with us and will be with us for some time, probably for years. And banks need to be, honestly assessing what their risk is. They need to be assured that they have the capital and the liquidity and the systems in place to manage this risk. The stress test that we apply to the largest institutions stressed commercial real estate pretty hard. And again, the conclusion is that the large banks can manage this problem. And most small banks can too, but it is in some smaller banks that tend to have that local concentration in commercial real estate. And, we're in touch with those banks. The supervisors and regulators are in touch with those banks and making sure that they can manage them. And it's going to be an issue for many banks, but it's one that we're trying to work through, one that we're very much aware of. And again, it'll be with us for some time.
Thank you. I think so much about the importance of these small regional community banks in small towns, even big towns in Minnesota, and how important it is that, in my book, that they can stay independent and better serve their communities in that way. So I worry about this risk. Thank you, Mr. Chair.
Thanks, Senator Smith. Senator Butler of California is recognized.
Thank you, Mr. Chairman. Chairman, good to see you. And I am going to make you do the whole last 5 minutes, since I'm the last one for today. You'll recall the first time that we spoke, I tried to engage you around 3 specific areas. One was how the monetary policy impacts the quality of life for young Americans in the future and the work that you are doing there, the space of climate risk, and what I see as potentially a future challenge down the road, and that is the state of commercial real estate. You and I have had that conversation before, and no surprises today. I'm going to stick to those 3 topics. Somewhat related to questions that you've been asked before relative to the housing market, housing affordability, and interest rates. I want to narrow the scope just a little bit to ask about those issues and challenges impact, again, the quality of life for America's next generation. Given the severe shortage of affordable and available homes to buy, coupled with high interest rates, young Americans are continually unable to afford homes and are pushed into a rental market, driving rental costs up. So there is sort of trickle-down impact here. A recent Washington Post analysis showed that Gen Z is spending 31% more on housing than their millennial counterparts were 10 years ago after adjusting for inflation. How do you view, that was a long lead-in to just ask the question, how do you envision or view the interest rates of today and the monetary policy balancing that the Fed is doing on contributing to the future generation predicament if we are to extrapolate the conditions of today?
So our job, of course, is the whole economy and inflation for the whole economy. And the absolute best thing we can do for younger people is to restore price stability so that as we benefited from, I graduated from college in 1975, near the end of the big inflation period. So during most of my adult life, inflation has just been not a factor. And that means, stable interest rates, relatively low interest rates. We want to get back to that. And that is what the Fed's job is that we're not supposed to look at the housing market as separate from the overall economy. In the meantime, though, there's no question that higher interest rates are making it harder to buy homes in the short term. But in the longer term, this is the best thing particularly for younger people who are not yet in the housing market.
Let me sort of in line with that community, constituency, population, and definitely aligned with the concerns of my state that's actually facing some severe climate impacts, just as we speak with wildfires.
Maybe CRE would be the
and
dark
our
horse of
colleagues
this hearing.
and fellow Americans in Texas and the impact of the hurricane. I wanted to pull in your sort of thoughts about the Fed pilot on the climate scenario exercise. In May, the Fed conducted a pilot climate scenario exercise and asked the 6 largest U.S. banks to examine their balance sheets and how it would be effective if a large hurricane hit the Northeast. They reported facing data gaps on property characteristics, their counterparties and insurance coverage. How does the Federal Reserve intend to invest in expanding the modeling resources for banks that are implementing climate-related financial disclosures?
So we haven't made any decisions on what to do with that information or whether to repeat that exercise. To your point, it was really a learning exercise. How are banks thinking about this, and how are they modeling it, and how does it work really? It's a very, very challenging thing to model. And so that was really the nature of this exercise. In terms of disclosures, we don't really have that's not really our job. That's really the SEC. So, but we don't have a big job on climate, but what it really is to make sure that the institutions we regulate are aware of and understand the risks that they run, including risks from climate.
And that they're prepared, and learning how to, as would be the point of a pilot, learning how to mitigate those risks over time. So what criteria will you use to evaluate whether or not you would run the exercise again and/or share more broadly the results of that exercise?
I think we did publish, most of the results of that exercise. So I don't know what to say about that. We're looking at it and we're asking ourselves, what did we learn? What do we need to learn next time? So, I'm not exactly sure what factors we'll be looking at, but we'll be doing a careful assessment of what more we need to do.
Thanks. Thank you, Mr. Chairman.
Senator Hagerty is recognized.
Thank you, Mr. Chairman. Chairman Powell, welcome. Chairman, last week in Portugal, you said that you wanted to be, quote, more confident that inflation is moving sustainably down before you begin to cut rates. You also said in your testimony that you need greater confidence and more good data before lowering rates. Can you give us any color as to what it is you're looking for in the data and how long it might take us to get there?
We need just to see more good inflation data. That's all. We had 7 months of good inflation data at the end of last year. Then we had a quarter, really a month or so where inflation went up, and now we had one really good inflation reading and one pretty good one. We just need to see more so that
top end of the yield curve is moving up again too.
So are we
fast,
weeks away, months away?
Yeah, I mean, I'm going to try to avoid sending any really specific signals about time today because it's going to depend on the data. It also matters what's going on in the labor market, though. We've also said that if the labor market weakens unexpectedly, that could be a case for loosening policy as well. Really, we're weighing both those factors.
Here's one of my concerns. Yeah, I'm sure you probably share it, but we're coming off of a 40-year high in inflation. We've seen the rate of inflation coming down, but we haven't gotten to the 2% target. And my concern, for lack of a better term, is whether or not this might be transitory in terms of the data that we're seeing right now.
That's exactly why we're approaching this question carefully.
I thought that might be your answer. Thank you, Mr. Chairman. Can we shift now to the issuance of Treasury debt? The Fed is the largest holder
exclusive
of Treasury
Ivy
debt.
League social
February,
clubs
you
are
and I talked
desperate
about the
for members,
pressures
and
that
the
our
clubs
fiscal
lose
deficit is exerting on
popularity.
interest rates, which by
Some
extension
are
makes your job
implementing
more
looser
difficult.
dress codes,
I'd like to
discounted
talk this
dues,
time
and
about how
speed
Treasury
dating to boost
issuance
membership.
is impacting our economy and our monetary policy.
Oh no.
First, just a basic question. If Treasury issuance were to shift drastically, either to the long end or the short end of the curve, would that affect interest rates? Or maybe more simply, do changes in supply across maturities impact interest rates?
I'm going to have to donate more to Skull and Bones.
I mean, I think in theory they can.
No, I agree. As you know, the Treasury Borrowing Advisory Committee recommends that T-bills comprise between 15 and 20% of total U.S. debt. Right now, the Treasury is issuing T-bills significantly above that recommended range. Some people, including myself, believe that this is being done to artificially stimulate markets in the run-up to the election. And it's shocking how little attention this is getting.
What the fuck was that?
Any manipulation of debt management of this nature stimulates inflationary pressures and increases taxpayer burden because it's higher cost to issue these bills. So given that Treasury is issuing an excess of short-term debt, which pulls down longer-term rates, isn't it working at cross purposes with your monetary policy goals of taming inflation?
So we take Treasury's debt management decisions. We don't comment on them. We just do our jobs.
No, I'm
So
not asking
gonna-
for a comment on their decision, but just as a simple mathematical truth. If they're pulling down demand on the long end of the curve, doesn't that
I wouldn't
work
say
to
that that
contradict
has important inflation implications, no.
You know, it just feels to me the same way that the Biden administration drains the Strategic Petroleum Reserve, that undermines our ability to respond to energy shocks. When the Treasury manages its debt in this manner, it constrains our ability to respond to future economic shocks. And that opens our nation up to very real risk.
Oh, he's saying the
Whether
quiet
it be
part.
amplifying the effects of the Fed's balance sheet reduction, flooding the supply of one of the most
A world
important
without
short-term debt
Janet Yellen
instruments.
would be a
The risk
better
seems to me to be
place.
mounting for Treasury market disruption.
But she's just a
I'd like
symptom
to know
of
what
its
your thoughts are, Mr.
much
Chairman, about
larger
how the Fed will
disease.
navigate this, and whether you've had discussions with the Treasury about this growing dangerous dynamic.
No, we don't have a seat at the table on Treasury debt management. Treasury makes those decisions, and they don't have a seat at our table on monetary policy.
I just
We
think
don't
the
have a
risk
seat
is
at their
very
table.
obvious here, though, where we're headed with this type of portfolio
Honestly,
management.
it's just, it's completely out of bounds for me to comment on Treasury debt management in any
Well,
way.
I think you've been dealt a very difficult hand here, Mr. Chair. The Biden administration's policies aimed to gin up the economy ahead of the election. These efforts directly undermine your policy goals at the Fed. That includes excessive issuance of short-term debt. Think about it, Freddie Mac's backstop of second mortgages, unlawful student debt loan cancellations, the draining of the Strategic Petroleum Reserve to suppress fuel prices, and President Biden's own jawboning of the FOMC to lower rates. As you know, the Federal Reserve was structured to shield monetary policy from political influence, and that independence has given the Fed unique credibility in executing its mission. If the FOMC were influenced in any way by political calculation rather than economic data, it would severely damage the Fed's credibility as an independent institution, it would increase uncertainty in our markets, and it would jeopardize the dollar status as the global reserve currency. Thank you, Mr. Chair.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. When the CEOs of giant banks can boost their bonuses by getting the banks to take on more risk, they run the risk that they will end up running their banks into the ground. It happened in 2008 and it happened again in 2023. Back in 2010, though, Congress passed the Dodd-Frank Act. Section 956 told financial regulators, solve this problem. 2 months ago, regulators put forward a proposal, but the Fed refused to join. Now, in 2018, you told this committee, Mr. Chairman, that you, quote, expect that banks will have in place compensation plans that do not provide incentives for excessive risk-taking. In other words, you trusted the banks to write their own rules. So let's see if they actually have. One thing the proposal would do is require big banks to delay bonuses for a broad group of critical employees who are able to gamble with the bank's finances, like the head of a trading desk, for example. Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks have put policies in place to delay annual bonuses for this broader group of critical employees whose risk-taking
The
could
Battle of
endanger
Rich
the
v.
bank?
Poor, both of these guys are on the same
I
side.
don't know
Yep.
specifically. My guess is all of them, since the
So
financial crisis.
you're the regulator who said, trust the banks to self-regulate so we can avoid another financial meltdown or another bailout. And you don't know if they did or didn't do that?
Well, it's a very, very specific,
Yeah,
narrow
it is a
question
very
you're
specific
asking
thing,
about.
because it's something a regulator should do. You think the answer is 10 out of 10? The answer is 0 out of 10.
Yeah, I doubt that.
Well, go back and look, because we've looked at their statements on this. Another thing the proposed rule would do is require the banks to consider flat out banning bonuses and bonus pay for executives who took risks that threatened the stability of the bank. So let me ask you this one, Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks now have policies that would require them to flat out deny bonuses to executives that have engaged in inappropriate risk-taking?
I don't know the answer to that. By the way, I never said trust the banks to regulate themselves.
I'm sorry, do you want me to go back and quote you again exactly?
Trust the banks to regulate themselves?
When you say, I expect that the banks will have in place compensation plans that do not provide incentives for excessive risk-taking.
Right,
I
pursuant to
take that as-
the guidance that we issued in 2010, which is quite
And you
detailed.
have not issued a guidance since you made these comments, since you became chair. And how many banks have actually put in place the regulations that you said, I expect the banks will have in place? The answer is, out of 10,
It was covered
zero.
by the 2010 guidance, actually.
No, you said in 2018 that they would put these in
I
place.
said they would have in
and
place.
no, that is not what you said. So look, Chair Powell, the last guidance on this subject, as you say, was in 2010, which is before you were at the Fed. The Fed has now refused to join the other financial regulators in
This is
finalizing
actually
a
pretty
rule
great.
implementing Section 956 as Congress directed. So my question has been, how many of the 10 biggest banks have done this? And the answer is zero. Dodd-Frank was passed 14 years ago. There are still no rules to stop banks from rewarding executives' risky behavior. When you were asked about these Section 956 rules or lack of rules in March of this year, you said, quote, that you wanted to understand the problem we're solving before proposing a rule. Chair Powell, the law does not say Jerome Powell, in his infinite wisdom, should decide if we have a problem with executive compensation. The law passed 14 years ago says executive pay is a problem that threatens the stability of our economy, so write the rules to rein them in. Finally, the other financial regulators have proposed such a rule, but the Fed has not joined. Chair Powell, I understand why the 10 biggest banks in the country like your approach. You let them do whatever they want, but you don't work for the giant banks, you work for the American people. I urge you to do your job. Thank you, Mr. Chairman.
Senator Vance from Ohio is recognized.
Thank you, Mr. Chairman, and thanks, Chair Powell, for being here. I appreciate you coming by our office.
It's like the weirdest
last
boner.
week to discuss some of these issues. I wanted to ask something I imagine most of my colleagues are not asking, which is the relationship between immigration, particularly extremely high illegal immigration levels under the Biden administration, and the persistence of the inflation problem. And I recognize this is not your.
I know a lot of you guys
policy
don't like her,
focus,
but
you are the Federal Reserve Chairman.
she's
so
the
I just
only
wanna get
senator,
your
the only
views on
fucking
this. And
one
in particular,
that directly
I would read you a quote
addresses the
from,
actual problems with the financial
Mike,
system.
Mickey Bowman, who's one of your governors. And this says,
Is this
quote,
the
"There's a
Appalachia
risk that
guy?
increased immigration
No,
and
he's a
continued labor
congressman,
market
right?
tightness could lead to persistently high core services inflation. Given the current low inventory of affordable housing, the inflow of new immigrants in some geographic areas could result in upward pressure on rents as additional housing supply may take time to materialize. With labor markets remaining tight, wage growth has been elevated at around or above 4%, still higher than the pace consistent with our 2% inflation goal, given trend productivity growth." The Bank of England, I believe, produced a recent report on this issue in the United Kingdom, obviously a different economy in a different country. But what do you see as the relationship, in particular, given that housing is such a big driver
like,
of the inflation that we've seen over the last few years?
far
Senator
from
Haggerty
center
said,
to ever
the highest
be
in
a
40 years.
viable
What
candidate.
role do you see illegal immigration playing in driving up housing costs, which of course is a main driver of inflation for American citizens?
Americans
Quickly
can't even
start
afford
by
fucking
echoing your
houses.
First comment, which is we don't comment on immigration.
No one's worried
policy, but we
about
do
people
comment on
running over the
inflation. So,
border with a knapsack
would
full
say
of
this,
like tacos.
Many people came into the country over the
This
last
is such
couple of
bullshit.
years, many of them through asylum requests.
It's like,
to
that
work.
fucking guy at Home
Labor
Depot
supply
making
increased
$100 a
great
day
deal.
is going to outbid me on my 3-bed, 4-bath.
There's no clear answer, but my my sense is that in the long run, immigration is kind of
No,
neutral.
they're
on inflation. In the
racist.
short
I'm
run,
pointing
it
out the
actually
racism.
helped because the labor market got looser because there were more people. But to you're talking about housing specifically. There will be, I'm sure there are places in the country where new people coming into the country, I'm sure you can find places and they exist where that will have contributed to an already tight housing market. But overall, in terms of aggregate inflation, I wouldn't say it's a driver one way or the other.
So I want to follow up on that thread, but just on that topic of particular areas that have been affected. Chairman Brown, I'd like to ask unanimous consent to submit a letter for the record from the city of Springfield in our state, the southwestern part of our state, which I think highlights a very real example of this particular concern, straight from the horse's mouth itself. Now this letter, I want to quote from it. Springfield has seen a surge in population through immigration that has significantly impacted our ability as a community to produce enough housing opportunities for all. Springfield's Haitian population has increased 15 to 20,000 over the last 4 years in a community of under 60,000 previous residents, putting a significant strain on our resources and ability to provide ample housing for all of our residents. And end quote there. And Mike,
Without objection, so
thank you. In my conversations with folks in Springfield, it's not just housing. They're trying to build 5,000 new housing units, which is a very Herculean task in a town of about 55,000 people. But it's also hospital services, it's school services, there are a whole host of ways in which this immigration problem, I think, is having very real human consequences. But I want to go back to just one other question, Chair Powell, on
take more
this,
money from rich people
on this immigration and labor supply question. So one of the
I don't see the issue.
euphemistic ways in which economists, I think, sometimes talk about labor supply and immigration is they'll say something to the effect of, well, an increase in labor supply has put downward pressure on labor prices. And what they're effectively saying is an increase in immigration has put downward pressure on the wages of American workers.
Yeah, but rich people don't like that. But there's less of them.
You know, when you hear
democracy, right?
Your colleagues and
that's so great.
Other economists outside of the Fed talk about the influx of immigration and the fact that it, I think, admittedly has put downward pressure on wages.
Compounding gains, smooth operator.
That has put some downward pressure on inflation, but it also puts downward pressure on the wages that people earn to pay for their families. Why do we see that as a good thing? Or maybe that's wrong. Maybe the premise is fundamentally incorrect. But why do so many economists treat an influx of new labor as a good thing? If labor is constrained, labor supply is constrained, doesn't that lead to rising wages for American workers?
So we're not, I'm certainly not trying to put a value judgment on it. I will say that this is all happening over the last couple of years in a context
American wages
of an
don't go
extremely
up,
tight labor market.
ever.
Now a little bit less tight, significantly less tight, but you've got a worker shortage. You've got businesses who have jobs that are open. You have, more than one job opening for every unemployed person. So you've got a very tight labor market, and it's addressing that. And we're having wage increases are still very high, but they're coming down to a more sustainable level.
Fair. And Mr. Chair, I know I'm over time. Could I just one more question on this? Thank you. I understand your point, Chair Powell, and again, I'm not ascribing value judgments to you, but if we say we have a really tight labor market, and we say that there are more than one job openings per worker, there are two ways you could plausibly solve that, or probably more than that, but two obvious ways you could plausibly solve that. One is through a new influx of workers via the immigration system. Another way is by raising wages and bringing some of the workers that are on the sidelines. I'm thinking specifically of the 7 million prime age men that have dropped out of the labor force. Like, why isn't that more the focus of policymakers rather than, you see a labor shortage.
Getting a 2% wage bump isn't going to bring them back.
Why not try to boost wages in a way that brings some of those
Well,
workers
I'm
going to
unretire now.
That seems to be a much better focus from my perspective.
Certainly, that's a very constructive focus. I would agree. It's not, I don't think it has to be one or the other.
Here's everything you guys need to know
Maryland's recognized.
about wages in America. If you invest 50% of your salary every year for 10 years,
so far,
your investments will outpace your current wages and your future wages within 10 years.
Uptick in unemployment, but you know very well that that's a risk.
Wait, 1450 instead of 1425. Sign me the fuck up.
Of that of that danger. When you were here in March, you said that you were, quote, well aware, unquote, of the risk to unemployment of waiting too long to cut rates and, quote, very conscious of avoiding it, unquote. Since then, we have seen
Too bad my rent is
slowing in the economy
43% of
and a
my
rise,
wage. That's
in
because you're paying
unemployment.
somebody
I'm just
else's
reading
investment
something
account.
Today, an analysis with Diane Swank, KPMG's chief economist, who summed it up by saying, quote,
I didn't say
"The
it
ice
was
is thinning,
possible to
red
invest
flags are
50% of your
emerging for
wage.
the
I'm just
US
saying that if you were
economy,"
able to,
unquote. The engine
your
of the
investments would
economy, the labor
rapidly
market,
outpace
is
any
cooling
amount of
faster
money that you could
than
make.
previously known. The unemployment rate is above 4% for the first time since 2021.
Stop flexing
It
your
is
middle
taking
your
workers
middle
longer
class
to find
wealth in everyone's
jobs.
face, Greg.
Economic activity in the service sector, which is responsible for 2/3 of economic growth, slowed in June. So my question, Mr. Chairman, is how do you take all of these factors into account? Do you share my concern that as of today, there is a real risk of an increase in unemployment larger than is currently on your radar screen?
Yeah, I mean,
Also, there's no
absolutely.
chance 15% of my
I
wage
do
going towards my
even
port
more so
would
than
make me
March when we
richer.
see that. So
Don't
we've seen-
apologize. We already
I
know
think
you're
the latest,
Canadian.
data show that labor market conditions have now cooled considerably from where they were 2 years ago. And I wouldn't have said that until the last couple of readings. And I would say also that for a long time, the risks were more that we would fail to hit our inflation target. I think the risks as to the two statutory targets we have, price stability and maximum employment, I think those are coming much more into balance. My colleagues and I are looking at that, and we fully understand that we have to manage this process of administering the federal funds rate and deciding what to do with it in a way that manages both of those risks. And, the two mandates are equal under the law, and so, yes, we do get that.
Well, I appreciate that, and I appreciate the fact that you've seen that that calculation change since you were last here, because I think the data indicates that we are at risk now of not acting soon enough to curb the increase in unemployment, and that if we allow that to go too long, we may see a real uptick there. And so I'm pleased that that is very, very much on your radar screen, and hope that that will be a really deciding factor as you and your other Fed colleagues determine what to do with respect to interest rates. And as has been said in the housing sector, we are seeing the continuing drag created by high interest rates.
They're trying to
that
keep
has been
Delta from
I think
falling
all of our
negative here.
colleagues, as you probably heard today,
Pretty hard.
are
But they're
really
not
hearing
pushing the
from our
dispersion trade
constituents,
at all, which
understandably,
is
about
odd.
the very high housing prices, and it's slowed investment in other
And it's
sectors
probably
like
because
manufacturing,
conditions are
as
tightening
well.
a bit.
In my final minute, I would like to turn to the question that Senator Warren asked, because
Dollars back above
I asked your colleague,
105,
Vice
10
Chair
years
Barr,
back
about
above
exactly this,
4.3.
a question of implementing Section 956 of Dodd-Frank when he was before the committee just a short
Greeks on
time
Tesla.
ago,
One Gamma
May
Max is
16th,
158.
of this year.
Nothing else is anywhere
And
near a spot.
I asked him about why the Fed had not moved
Or, I'm sorry,
forward,
258.
along with other
It's like 258.30.
agencies, with respect to implementing what the law is and what the law has been for 10 years. NCUA has signaled their intent to propose a rule.
But there's still a significant
The
amount of
SEC
out-of-the-money
has
calls at
indicated that they're
260,
moving
255,
forward.
so
I said
it's got
to
support.
Vice Chair Barr that I've not seen any notice of proposed rule from the Fed, and can I get a commitment that the Fed will quickly begin to process implementing this law by issuing a notice of proposed rule? His
Gamma
answer
Max or
was,
Intel?
and I'm quoting,
Why is
"In
everyone trying to buy that
discussions with
piece
my
of shit?"
colleagues, it became apparent that at the board, we believe we need to conduct some further analysis before deciding what steps to take. We are committed to following the law, to implementing Section 956, but we have further work to do." Count me among those who are very frustrated that we're now 10 years
Gamma
after
Max
this law
on
was
Intel
passed,
is at
Vice
40.
Chair Barr committed to following the law. I'm sure, Mr. Chairman, you would commit to following the law. But why is it that it's taking the Fed so long to move forward with implementation of 956?
So I like to look at the actual language of the statute when and what it says is it calls on the regulators to make determinations about specific incentive compensation practices that cause
Yeah,
excessive risk
congressional
taking.
hearings tomorrow.
And then, and
We've also got a
haven't done that.
3-year. We got a
So
3-year.
We did. You know that we put in
coming
place
up
pretty serious
at 1
guidance
o'clock.
back in 2010. After putting it out for comment, we looked at all these questions. It's been in place for 14 years. We supervise on it, and so the question I'm asking is, okay, let's go out and look at what the practices are that are happening now, not that are happening before the global financial crisis. When
Surely
it was
Intel could
obvious
get themselves in a
that things
better
needed to be
position than
changed, and
NVIDIA.
we put the guidance
given
in
the
place.
fabs
It
are
seems
being
to have
built.
largely worked.
Well,
certainly as it
those are
relates to the
years
large
out,
firms. And then
and
let's design
Intel's
something that
management
is
is
designed
terrible.
to the residual risk, as opposed to just taking something off the shelf from 15 years ago and doing that. So we're working on that at the Fed now. And again, the statute requires us to prescribe regulations or guidelines to prohibit those things, and I want to do that. In a sense, we have done it.
Just very briefly, and is it your testimony that the Fed has already met the requirements of okay?
No.
Just want to make that clear, and we do look forward to the Fed moving forward. Thank you, Mr. Chairman.
Thank you, Senator Van Hollen. Senator Brett from Alabama is recognized.
Thank you, Mr. Chairman. Chair Powell, thank you for being with us today. My colleague from Maryland actually just touched on something, but as I was listening to the exchange from my colleague
No,
from
I don't think
Massachusetts
CMG is a
and her
good buy
closing
at all.
remarks, particularly
I
about
don't.
Dodd-Frank
I
and,
think most of the
956.
most of
There
the
was
growth
also
for
a
CMG
comment at
is
the end
largely
where
priced in
she
at this
mentioned you
point.
working for giant banks versus the American people. Now, I have a long list of questions I want to talk to you about, but I did want to get you to respond to that.
Yeah, that's completely untrue. The things that we're doing are consistent with our international obligations, and they're meant to be the best thing for the American economy, and that's really our only consideration. We have policy differences across various things, but we're all trying to achieve the best results we can for the people that we serve.
Absolutely, thank you. Chair Powell, I have repeatedly talked about my concern with long-term debt proposal, and just think that it has not been well thought through. First, I have concerns that it blatantly
When do we
undermines
start letting young
tailoring
people in the
requirement,
Senate?
And on that note, do you believe
don't think
that
she is.
2155 will be applicable to the long-term debt requirement?
I think it applies to everything. Absolutely. And on the long-term debt requirement, we have voluminous comments that we're looking at carefully and thinking through the process of what to do about them.
No, I appreciate that because I do believe that currently it lacks a real cost-benefit analysis.
Debt. Yeah.
And I think it really does need serious reconsideration.
250 is a
And
big
when you take a
resistance
look
on
at it
AMA.
and its overlapping nature with Basel III, it seems inappropriate that we would move forward with a new long-term debt proposal, finalizing that rule when we don't even really understand what Basel III is going to mean for capital requirements for banks and obviously financial institutions. So my question for you is just
I don't even know
would
who this
it be
person
inappropriate
is.
to move forward with the long-term debt proposal, finalizing that rule prior to Basel III being finalized as well?
I don't know that I would give you, I can't give you a clear answer on that. It will depend. I mean, Basel III won't be finalized for some time, but that's not to say we wouldn't reach a place where people understand and accept and support what it is that we're doing. And I think at that point, we could certainly move forward with other rules.
I heard you mention to one of my other colleagues that probably by the time this all took place, it would be the beginning of next year. I would just say my concern, the Fed has said that the long-term debt rule will directly be impacted by the final Basel product. And so, why would it be inappropriate or appropriate to move forward with that before banks can fully understand what they're facing from Basel? So I would just ask that y'all are thoughtful about that. These are a lot of things that people are dealing with and trying to really understand the implications of. And I think we have seen consistently that people are not taking a look at the cumulative impact of these things and not really taking a look at the trickle-down effect. And on that, on Basel, when you testified in March, you said the Fed was aware and fully considering
Her
the
name's not
potential
Kramer.
impacts of a proposal
She's
on
just
our
sitting in the
commodities
wrong
markets.
seat.
And I do want to talk about that. The commodities market, our agriculture industry,
Brit, isn't
is
it?
1 in 5 jobs in the state of Alabama. It's 20% of our economy. I am a big believer food security is national security, and the proposal would increase hedging costs by 80%. Meaning banks would be far less likely or inclined to offer clearing services. So this could have a detrimental effect to our agriculture
someone else's
community
placard
and
is in front of
increase
her.
other costs providing food and fiber for our
or it's
nation.
the angle of the
When you look
shot.
at inputs such as feed, seed, fertilizer prices, those have skyrocketed, and prices have ended up just getting passed down to the consumer. I mean, grocery prices are up 21% since January. So do you believe that the revised Basel proposal will alleviate these concerns that our farmers and our ag community have had about Basel
I don't know, do
III?
you make money
And has the
trading
Fed done
smooth?
anything specifically to take a look at this? And if not, will you commit to doing so?
Trading returns will
So I
always.
don't want to get into
will
the
always,
specific
I mean,
changes
as long
that
as
we're
you're
going to
making
make. I'll just say
returns,
that
will
we're
always
very well
outpace
aware of and very
long-term
focused on that
investments.
particular set of changes and, paying close attention to the issues you've raised.
I appreciate that, and I also hope that the Fed when you craft these types of regulation, you really consider the relationship between the economic impact and the ability of community banks
shouldn't
to
be a
serve their
choice
communities as
between
well.
the two,
I have
though.
heard you mention that to another one of my colleagues,
You
so I know that
should
you're
probably
committed
be,
to doing that, but that is
investing and
incredibly
saving for
important to
retirement, and then,
Alabamians,
and
our
you can
main
also
streets all
trade
across the
on
state.
top of that.
In my last few seconds, I want to touch on one more topic.
What's
so
a
finding
return?
solutions to
Never mind.
expanding affordable childcare is a top priority of mine, and it is something that I know a number of my colleagues on the other side of the aisle share an interest in and believe is an important issue as well. So Chair Powell, do you believe
She's
that
42.
increasing access to affordable childcare would positively impact labor participation in our country?
You know what we need? We need
do
to put
believe
the
that.
kids to
Thank you.
work.
Stowe of Nevada is recognized.
Thank you.
Did she just take her
Excuse me, Chair
placard
Powell,
with
thank you
her?
for joining us, and I always appreciate.
Do they have to take their
visiting with my
placards from
office
one
as
meeting
well
to the
and your
next?
Comments. Let me start by a comment you made in the opening. Over the past 2 years, you said the economy has made considerable progress toward the Federal Reserve's 2% inflation goal. Labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. And what we know is that since Biden came into office, the United States has added over 15 million jobs. Under President Biden, we had 41 consecutive months of job growth, and you've just said it again here today, that wages are up as well. Average U.S. wages and salaries grew by nearly, 16,700 between January 2021 and April 2024. So would you agree with the statement by our ranking member earlier today that the U.S. has the greatest economy on the planet?
I certainly would.
Let me ask you this. Jumping around, and there's been talks today about the Fed's independence and how important the Fed's independence is. The Wall Street Journal recently reported former Trump administration officials drafted policy options to weaken the independence of the Federal
comes the
Reserve
push
if
on
President Trump
dispersion,
were to
by
be
the
elected in
way.
November. Allegedly, former administration officials discussed policy options to erode the Fed's independence to make it easier for a president to impact interest rate decisions or fire the Fed chair at will. Chairman Powell, how important is it that the Fed has independence
She
to
doesn't
provide
sound like an
economic stability
Alabama.
and anchor our inflation expectations?
Probably not.
So I think it's actually essential, it's literally essential. And the good news is I think that's pretty broadly understood, and particularly on Capitol Hill on both sides of the aisle. I believe that people do understand that we need to do our work in a way that's outside the political process to the maximum extent possible. Of course, we need to be accountable and tremendously transparent. If you look at the box in the Monetary Policy Report on central bank
Born and
independence, it's really a
raised.
box about transparency. That's the other side. So I think it's really important. I think it's an institutional arrangement that has served the public well. And, and I do believe that there's pretty wide support for it.
And you just said that it has been intentional and institutional arrangement over the years for this very reason.
correct?
Yes, this is a choice that we make, and I think it's countries around the world, advanced economies have all made this choice effectively, and the results are clear that you now have independent central banks, and you have better anchored inflation expectations, and you have better performance on inflation and better performance in the economy generally, which isn't to say there won't be shocks and crises and that kind of thing.
And then let me touch on a subject that one of my colleagues just talked about, because I was going to ask about this, which is our immigration. In Nevada, immigrants are extremely important for our economy. They're essential workers, doctors, nurses, and teachers in my community. Can you, without getting into other ancillary issues that don't impact what you do, can you talk about and elaborate on how immigration affects the employment rate
One
and why
second.
you look at it, and for what reason you look at the immigration issue?
So we don't, as you, just to make the point that you made, we don't take a position, we don't comment on immigration policy. We have no responsibility for it. It's not our job. But, so we just look at the numbers and we sort of try to assess the economic consequences of immigration. And over the last 2 years, 2 years ago, we had an economy where we really had a labor shortage. And what's happened is we've had a wave of immigration, and many of those people have gone to work and gone to work legally through the asylum process. Not all of them. There's also a group that has not been legally processed, but many of this latest group have been have sought asylum and gone through the process of getting a work permit. So what that means is that employers wanted workers, and there were more job openings than there were people actively seeking work or working, and so now you have a new supply of workers, and they've filled those jobs. So we have a bigger economy, but it's not a tighter economy because labor supply has increased the economic capacity. That's just the arithmetic. That's not saying it's a good thing or a bad thing. There are
And
other
so-
policy choices that could be made, and they're not for us to make.
When you say greater economy,
A larger economy.
in other words, it has improved the growth of our economy.
All right, the economy grew 3.4%, I believe, last year. And some part of that was that, as Congressional Budget Office analysis showed, and to many's surprise, there had been a really significant uncounted group of workers coming into the country who had gone to work. And that's part of the story of how the economy managed to grow that much while inflation was coming down pretty sharply. Inflation came down 2 full percentage points during 2023 while the economy was growing at 3.4%. So, and while these people were coming in, so that is part of the explanation for why we had such an interesting and pretty good year in 2023.
Thank you.
Senator Kramer of North Dakota is recognized.
Hi, Mr. Chairman. Thank you, Chairman. As always, all of my prep goes out the window with the last question. So on the legal immigration workforce front, and I know this isn't your bailiwick, but the issue of workforce is important to the economy. I would submit to my colleagues, beyond even the people who come here seeking asylum suddenly being available for the workforce, we have 1 million plus people who we welcome in legally every year, the vast majority of whom don't come in with a job or even a skill set. We have so much work to do, colleagues, on the legal immigration front to create a connection between economic demands for workers and the skill set and education that our immigrants bring to us. So most every other country requires some sort of skill set useful in the economy. We don't do much of that. So that's just my speech for the moment. I know, Mr. Chairman, you've gotten already lots of very specific questions, and I've heard a couple of them on Basel III. So I'm just going to make an illustration, and you can comment on it if you'd like. But there's a large generation and transmission utility in North Dakota, rural electric cooperative, Basin Electric, very large G&T, members all over the upper Midwest. And they recently testified in front of the CFTC on Basel III, and they expressed a concern about how operations would be impacted if lending was curtailed or limited in any way.
And they gave a real world example, and I want to just give you that example. Now,
Aurora
remember, this is
self-driving
electricity
tech, 2
supply
or 3 years
that we're
old,
talking
billion
about.
in cash, billion in
It's
shares.
critical it remains reliable. It's critical that
We're
it
going
remains
to be in an
affordable.
uptrend
And
from
part of an
all-time
electric
low.
cooperative's risk management program, of course, is how it buys the fuel that generates the electricity. In this case, natural gas. They may buy natural gas in advance at a fixed price, realizing natural gas is one of those commodities that goes up and down and pretty big swings at times.
What's their
But
ticker?
they can hedge by buying it at a fixed price for a power plant. And it protects the cooperative financially, since electricity prices, again, follow those spot prices generally. So if spot prices spike, so do electricity prices. However, with a natural gas hedge, the cooperative can generate electricity at a lower fixed fuel cost, protecting itself and its consumers from high prices. It's an upfront cost on the balance sheet between the cooperative and its bank, but it protects the reliability and affordable
Not
supply
trading,
of electricity.
invest,
I give
long
you that very
S&P,
specific
nothing
example,
else.
not even to mention that the cooperative model itself.
Your average
has
returns should be
some
about
unique
10%, right?
qualities about
That's
it.
the long run.
If you would like to comment on it, you've already stated that.
That's
there's
the
gonna have to be
long run
changes.
average
I just throw
return.
that into your box of things to think about, and you're welcome to comment if you'd like.
I'll just say, we're well aware of that issue, and I appreciate you bringing it up.
Thank you, Mr. Chairman. With that, then, I'm just going to speak to this independence issue. I think that the senators that have questioned you on it are correct. I share that concern, as you know, that the independence of the Fed is essential. I have resisted moves within my own party to change it.
A year.
But those moves are very narrow and not very, I don't think, very realistic. And I appreciate you pointing out that from what you can tell, at least on Capitol Hill, we're all pretty much united on that front. Perception does matter. It matters a great deal. And you and I have had discussions over the years on, you were very, you admonished us strongly as Congress to spend what we needed to spend to get through the pandemic and to maintain the economy. I think you were right to do that. You were just as aggressive in not responding to calls to rein it in a little bit when Democrats brought the Inflation Reduction Act and the American Rescue Plan to the forefront, and I think really basically hijacked the economy and put fuel on inflation. But perception matters, and so I would just submit to you, and you haven't said you're going to do this. I don't have any reason to believe you'll do this, but any move to lower interest rates or move interest rates either direction before November 5th could certainly be a bad perception, even if there's a strong push to do that. I know you understand that, but I just want you to know that as long as you remain independent, I'll be on your side. I think neutral is a good place to be. And by the way, you have one of those jobs where being boring is one of the most noble things you can be. So great job. Thank you.
We do our
Thank you,
best.
Mr.
Senator Kramer. Senator Warnock is recognized, who is decidedly not boring.
Thank you very much, Mr. Chairman. The latest monetary policy report shows inflation in housing costs is gradually easing. That's good news. But many Georgians still feel the sting of unaffordable homes and mortgages. And one reason for this, you and I have discussed this, is that we aren't building enough houses. 2022 study published in the Journal of Economic Geography found that for every 10% increase in the housing stock, rents decreased by 1%. We've discussed this issue, particularly the effects of housing supply on housing costs. And we agreed that while the Federal Reserve does not control housing supply, it can help create the environment that encourages the construction of new housing, particularly affordable housing. Chair Powell, how has the Fed been working to foster an environment that encourages home construction, and what, in your view, are the challenges that remain?
So, I mean, in the long run, the absolute best thing we can do for the housing market and for the economy is to sustainably bring inflation back down so that people aren't talking about it anymore. And it's just assumed by everybody in their daily lives that inflation will be around 2%, so we don't need to talk about it, which is where we were for a long time. We want to get back to that. Interest rates can come down then, and the housing market can return to the state it was in before the pandemic, which was to say really tight. We don't have enough housing, and that's not really a monetary policy issue. In the short term, though, I would say
Gherkin shilling
tight
Boo
monetary
and
policy
chill.
weighs
I mean, that's
on
the
housing
return on
market.
Boo and
We-
chill, right?
The policy works through interest-sensitive
On
spending. and
$500,000
housing
invested.
is definitely at the top of the list of interest-sensitive spending. So we understand that.
Well,
we're
50,000 a year invested,
suppressing-
future value.
Not suppressing, but our higher interest rates, have led to lower housing starts and lower activity in the housing market. But we're doing that to get back to 2%.
It's really not
inflation
that
for the whole
sexy.
economy, so that the housing market can be on a better foundation.
Well, yeah, and related to that, when you
It's
have
just,
these high interest
it
rates,
is
of
what it
course,
is, but it's not.
You see
it's not
across
sexy.
the country, but particularly in a state like Georgia.
For poors it is, yeah, I guess.
These institutional investors who are coming into the space, and they're buying houses in all cash, boxing out first generation home buyers. And of course, the conditions for them doing that improve to their favor with higher interest rates. Would you agree with that assessment?
I know some of that's happening. I don't know that higher interest rates make it. I mean, some of that's, they're working with.
Well, you got higher interest rates and you got institutional buyers who can purchase it all cash. Doesn't that further?
But they have to borrow the money at higher interest rates. I'm just saying higher interest rates doesn't make their investment any cheaper. And notwithstanding, I understand it's a sensitive issue, and in most markets, it's still a pretty small portion of the outstanding housing stock. But it's not an issue. It's not an issue for us. They're a legal buyer of housing. Our job is really the whole economy. I mean, it's more of a question for legislatures.
So how can the Fed better deploy its monetary tools to ensure that we are meeting key inflation objectives like housing affordability?
I think the best thing we can do is is kind of what we think we've been doing, which is to move carefully as we think about loosening policy and make sure that we do that when we've got greater confidence that inflation is moving sustainably down toward 2%. We're also keeping a close eye on the labor market, and if we see unexpected weakening there, then we could respond to that too. But that's really the best thing we can do for the whole economy, and very specifically for the housing market too.
You well point out that you're limited in terms of your influence there, and there is a role for Congress, to be sure, which is one of the reasons I wanted to be on this committee, to introduce a down payment toward Equity Act with my colleague, Senator Butler. This bill would help first-generation home buyers compete with Wall Street institutional investors by helping with down payment costs, closing costs, and costs to reduce interest rates. I look forward to continuing productive conversations with you and looking at how we can make housing more affordable for all Americans. I'm running out of time here, but one of the other concerns that I maintain is with respect to reducing the racial wealth gap is this issue around home appraisals. And the Fed is part of the interagency task force on property appraisal and valuation equity. What expertise and perspective has the Fed brought to this task force? How are you responding to this issue of home appraisals?
So, as you know, we've been an active participant in that task force, and we bring all of the expertise we have in the housing market, as well as regulatory, supervisory, and economic expertise generally, as we look at that. And I'll also say that our strongly held view is that discrimination has no place in the banking system, and that includes appraisals and other valuations.
I agree with that, and quickly, I was glad to see that CFPB and other agencies recently finalized a rule that creates strong anti-discrimination standards for automated home evaluations. The Fed has not yet approved this rule. Why not, and does the Fed plan to do so?
Sorry, why do we?
You've not yet approved the rule that was made, that was suggested by the CFPB. They finalized the rule.
But do we? Sorry, I didn't. I'm not aware that it's a rule that we have to finalize too. Is that the case?
That is my understanding.
I will. Let me follow up with you on that. I'm not aware of that.
Okay.
Thank you.
Thank you.
Senator Daines of Montana is recognized.
Chairman, thank you. Chairman Powell, thanks for being here today. Certainly, it's not lost on anybody here. Election season's in full swing. And so from now until Election Day, my Democratic colleagues in Congress, as well as the Biden-Harris administration, will waste no time attempting to sell a fairy tale to the American people that financially and economically, they are better off now than they were almost 4 years ago. When President Biden took office, inflation was at 1.4%. His failed policies drove us to the highest inflation we've seen in 40 years. I can tell you the folks back home in Montana aren't fooled, because in every part of their lives, inflation is not some kind of hypothetical. They see the everyday impacts of the decades-high inflation brought on by the policies of the Biden administration and facilitated by congressional Democrats. The cost of most goods and services across the economy are more expensive than they were in 2020, and that is a fact that no amount of political spin or mental gymnastics can make go away. Here's just a couple of examples. Breakfast cereal. Prices have increased 28% since January of 2020. Gas prices increased 36% from a national average of $2.63 a gallon to $3.58 per gallon. Egg prices have jumped $3 per dozen in 2024, double the cost of $1.45 in February of 2020. And this dishonesty doesn't stop with inflation. On the labor market,
People screeching about the
President Biden
disconnect
and Senate
between
Democrats are
SPX and
celebrating a
underlying
victory lap
securities
in light of the
when they
recent
ignore that
jobs
SPX is
report,
reflective of 30
showing
days on the future futures
206,000
pricing.
new jobs.
It's a diagonal
last
spread.
month.
It's absolutely
They're
not.
willfully ignoring the fact that more than a third of these job gains
What?
came from the government sector. Mr. Chairman, I commend you for the job you have done thus far in trying to rein in inflation. I encourage you to continue the fight despite the political pressures you may face. I'm also encouraged by the comments you made earlier this month
Coin's
about the
doing a
dire
thing.
need
Good.
for
I bought
Washington to
calls
address its
earlier.
fiscal imbalance. I couldn't agree more.
No, SPX
I've said
is
many
just the
times and
current
continue to believe
valuation of
that Washington's
the
culture of
underlying
reckless spending,
stocks.
of excessive borrowing, is leading us down a very dangerous path by leaving future generations
It's
with
a market
mountains
cap
of
weighted
debt.
index.
And I'm happy to hear you agree with that assessment. Mr. Chairman, given that it's an election
Options
year, we're
on
undoubtedly
SPX,
facing
I mean,
immense
are a
political
bet
pressure
on the
to
future
lower
price of SPX.
Thus far, you've
but
done an admirable job.
still
in
nothing
using
to
the
do with
tools at your
futures.
disposal to fight inflation.
SPX is
and
hedged
urge you to
heavily
continue
with
to be led by
futures.
data and not calendars or political influence.
So there are
You said as
relationships, but
recently as
that's
last week that
not
while things
that's
are
not
trending in the right direction, you would need to see further evidence before cutting rates. So here's my question, Mr.
You
Chairman.
didn't do the Broken Wing on
What
Coin? I
specifically
did,
are
but I
you
also
looking
bought
at
calls.
and looking for as we head into the next FOMC meeting, and how do you factor in this?
So yeah,
recent labor data?
50,000. That same
Certainly
$50,000
part of
at
that new government
3% a
jobs.
month is
We're looking for two things, really.
11,556,000
One is just more good inflation data.
in
We
10
had quite a lot
years.
of good inflation data.
Smooth.
the
So
last
that's
7 months of last year.
you
Then
know,
we had
but
kind of
it
a bump
carries
in
a much
inflation in the
greater
first quarter.
risk of loss,
And now
right?
we've had one good and one very good inflation.
So
rate.
$500,000
So
into
we can be
$800,000 over
confident
10
that what we're
years,
seeing is where-
or
that's where inflation's going. That it's going back
$50,000
towards
into
2%.
$11
We
million
see that
over 10
2%.
years.
Right now, we're at 2.6%. So
Right,
that's-
and
that's
this
on
is
inflation.
why
On the
trading
labor
is
market, to your
attractive to
question,
people. That doesn't mean they'll be good at it, or they'll succeed at it,
we've
or they'll
seen that
make
the labor
3%
market has cooled
compounding
really
a month for
significantly.
10 years, right?
Across so many measures, and a number of people here today have pointed them out, but and the unemployment rate has moved up. You see a labor
But the
market that is now
potential's
pretty much in balance,
much
pretty
higher.
much where it was in 2019. It's not a source of broad inflationary pressures for the economy now, but it's still a strong labor market. You know, 4.1% unemployment is a very good and historically low unemployment rate. So we have a mandate to support maximum employment.
That unemployment
and we
rate is
also
not
are paying
accurate,
close
sir.
attention. And if we see that the labor market were weakening unexpectedly, which is to say, you know, more than what we've seen in a material way.
You need data on a put ramp?
unexpectedly,
On what?
Then we could also respond to that because we have a dual mandate and we now see the two mandates as more in balance than they were A year ago, really, the focus had to be and was on inflation. Now, we need to be focusing on both goals.
Chairman, thank you. I want to get one question on Basel III, and then we will. In March, this committee agreed that it was seriously flawed and needed to be completely rewritten. I was encouraged to see reports last month that the Federal Reserve had provided other financial regulations with possible changes to the proposal. My question is, I continue to believe the proposal should be scrapped altogether, but could you share what changes you're planning to make and the status of the
Squeezing
ongoing development
anything?
of the updated proposal?
No.
So we've had extensive discussions led by Vice Chair for Supervision Barr.
If
with
we
the
got
FDIC
above
and OCC.
5,600,
We made a lot of
maybe.
progress in getting close
But
to
like
an
the
agreement
90,
on
I don't think the
those
90,
changes.
95s are
What-
even
the
sold
work that
here.
remains is to agree on a process forward. How are we going to move forward? It is our view institutionally that
Does
we need
75
to
become a
put the
stronger
changes out
support?
for
Yeah.
comment for some period of time, so that the public, all members of the public who want to comment, can see them
Dispersion's
again,
still
comment on them
underperforming,
again, see
though.
them in
Like,
the context
like
of the quantitative
dispersion
impact
into tech
survey that we
is
did.
still
And
underperforming,
that's the right
which
way to
is
proceed.
interesting.
That's how we would ordinarily proceed, and we don't see why we would deviate from that. And this is the conversation we're now having with the leadership of the FDIC and the OCC.
But
and my hope is that we'll be able
performance
to come
and
together
breadth
around
isn't
a
really
way to
helping.
proceed forward, very soon.
I think it's
hope
still
we would have done
Dow's
so by
still
now,
down,
but I
Russell's
believe
still
we will
down.
do so fairly soon.
Thank
They're
you for
up a
joining us
bit
today, Chair
intraday.
Powell. I look forward to working with you to strengthen
And
this
Dow's
economy. For
bouncing
senators who
back,
wish to
but-
submit questions for the hearing record, they're due 1 week from today, July 16th. To Chair Powell, please submit your responses to questions for the record 45 days, no more than 45 days from the day you receive them. Thank you for your testimony. The committee's adjourned.
Oh, that was interesting. Now they can pump properly. Yeah. They're starting to short ball. We might get a push up into like the 90, 95 range. I still think there's a lot of resistance at 59.95, 5600. I mean, this is what I called for today, right? We chop between like 55.90, 55.75. Is UJ heading towards 2025, or are we gonna bounce back? Energy's getting beat up right now, so this is probably a better opportunity to, well, not quite yet, but almost a better opportunity to get another like DCA entry, which I'll probably be targeting if it gets back to 20. I don't know if it will. It's still a long way off, right? It's almost a 10% drop from where it's trading now. And it does look like kind of a double bottom at the 22. It still needs to break back above 23 to confirm that. But it took a big hit after the last dividend. It hasn't really recovered yet. Up 55, 90, 95 if they're buying. I mean, we could even, depending on like where we're sitting end of day, we could push higher than that. But that's where I expect us to run into resistance. $90 could be, but only if they start selling it really heavily. The biggest problem here is there's a lot of weakness in QQQ, right? Financial conditions are tightening, and so the dispersion trade has been loosening up all day. They're starting to turn it around now, but like the last couple hours, right, we've been seeing dispersion break down. So now we'll have to see if they try to push it into, rates coming back, like rates, especially on the long term, coming back down and the dollar dropping. So if rates fall back, then they'll push the dispersion trade again. And that'll be like QQQ pumping tech, right? Which I expect them to do. I mean, There's no reason for us to go down yet. Not substantially. 75 looks pretty well defended, so. How are we turning 50K into 11.5 million? If you can make 3% a month. For 10 years. Consistently. Or average 3% a month over 10 years. Which is very hard. It sounds easy, but it's not. But I was discussing the advantage of trading, right? It obviously carries a significant amount of risk. Hear me out. 3% a day every day for 6 months. Not possible. Not possible, but the math checks out. Okay, yeah, if you could find a way to do it, sure. But you won't. Not with appropriate risk management. Not with any risk management. I just sell out of the money monthly put spreads on SPX every month and make significantly more than 3% a day on average. I do. Well, not spreads, because fuck that, right? Just puts. It's harder to make 3% the more capital you have, so it literally gets harder every single day. Yeah. I just did compounding gains over 120 months. Message clear. Don't use risk management. That's not the message. The message is even a low rate of return can drastic like selling options, right? A low rate of return, pennies in front of a steamroller, risk managed. Say you can yield, I don't know, 0.2% a day. You would still drastically outpace the average returns of the S&P. Particularly on Microsoft monthly covered calls. I mean, the problem with approaching income strategies with covered calls is that your asset is still the underlying, right? So if the price of Microsoft drops 10%, your 3% return is destroyed, right? Us and Fubo know this well. I feel like Fubo's been awesome. You just have to be greedy with it. I think this is the problem that most rational people with not a lot of market experience have, is they refuse to use their covered calls to short the stock they own. I almost exclusively do this with covered calls because the returns are so good. I've showed you like for fucking 3 years, How do you balance your views on poor macro environment with selling puts on indexes for more than pennies with huge tail risk? Well, I figure everyone else has bigger tail risk. I mean, I also don't sell them for pennies, and I can hedge them. I have like hedging mechanisms in place that would protect me. Because you can just add spreads as the price falls. I mean, yeah, always covering yourself with a spread is fine, but ultimately you need to outpace the one drawdown event you're going to experience, right? So your returns, I mean, it's a more aggressive approach, but I prefer my returns to outpace my drawdown potential as quickly as possible. We didn't do 100 years, Thunder. VNGM today or VNGM move up? We could get over monthly VN. It'll be tough, but you can do it briefly. We rejected off of it twice today already. So it'll be hard, but as we move into the end of the day, they can get enough like out of the money long gamma to push through it. You have to push hard enough that you're offsetting the market maker's constant tick by tick selling, though. Yeah, Aaron, just think of it like this. You know, you can sell someone delta against your position, right? Everyone does this. Everyone sells theta, right? But ultimately, the returns on selling theta are relatively the same as selling delta, right? Over like a 45-day period, you know, both contracts are going to lose value. The difference is this contract has a lot more potential to lose premium than this one. So yeah, this is nice, you know, price go up, right? And you know, you get assigned at a price higher than your like cost basis, right? So your cost basis is somewhere in the middle. But if you sell delta, right, and the stock trades flat, you can just close it for slightly less premium than you sold it for. And since you're already betting on the stock trading flat, but if you bet on the stock trading flat or down, then selling delta is more advantageous. Because of the price drops, not only do you protect your underlying from a decline in price, but you also profit from the decline in delta. I mean, Veda? Why do you sell your puts so far out of the fucking money? Vega puts broadly hedge my long-term exposure, not my options exposure. QQQ is way too weak. This isn't good. Yeah, little upside gap, I guess. Higher low. If it bounces here. Tough time breaking through VWAP, though. I only sell row. So you really need them to cut rates. Still waiting for 575 on AQN for more DCA. Not necessarily. I'm pretty willing to buy it all the way up to like 650. Is the price action on Upstart and Beyond covering? Beyond's starting to see a little bit of covering. Upstart's not. Upstart's mostly just bouncing around the sold calls on the lower side of 25. I saw an article last night, some FinTwit saying the Fed was going to cut rates 3 times between now and the end of the year. I got excited because market crash. I don't think the Fed cuts rates. I still don't think they can. I think they're just trapped. I don't think they could raise rates either. Thank you very much for the time and attention today. Well, it wasn't just for your benefit. But, you know, I mean, when you're thinking about structuring how you invest, right? You should probably try to capture the best of both, right? So, you know, if you're investing like 50K a year and you are a somewhat proficient trader, right? Like you make money instead of lose it, which is, I understand, not everyone. You know, you would probably divide up that investment, right? You might allocate like 10% of your 10 or 20% of your total into, you know, what would be very high risk, which would be trading, right? And then you would probably, you know, want some like growth, some bonds, some defensives. That's $5 grand. Yeah. I know how much it is. Well, 5 to 10 grand, depending on, you know, age, I guess. Yeah, or your proficiency in trading. I've managed to keep this piece of shit account alive on what, $1,200 for like 9 months. I saw you and Kevin streaming. Kevin had bad takes, like if you're poor, get a job. He seems to be disconnected from the reality, even about inflation. I don't really know anything about the guy. I've never watched him, but I all I've ever seen are like some clips, right? And all of the clips seem to be him going, "Houses awesome, leverage and buy houses." Right? He doesn't explain how, or the opportunity cost or anything like that. It's just leverage and buy houses. I bought houses. Look how much money I have. Which is, I mean, not an investment strategy, right? Like that's most finfluencers though, right? It's just like, oh, like I made money doing this and this is my platform to brag about it. I assume he means Meet Kevin. Meet Kevin apparently explains the how if you pay for his $15,000 course. God damn, Dillionaire is way too cheap. Am I just doing this all wrong? Yes. Who the fuck is paying 15,000 though? Boomers. Boomers and millennials with money that have no like fiscal, like financial education at all. Dork, I need QQQ to go back up, man. You know that new website you're building? Maybe get Meet Kevin to price it for you. That's a great idea. The thing is, Dillionaires doesn't teach how to trade. It shouldn't. That's a bad way to learn how to trade. Successful trading is about education and knowledge of how markets work, not about following a system. Because if you learn a system, that's all you know. You cannot adapt. You cannot change with market dynamics. And when even if that system is profitable initially, over time it won't be. And you'll find yourself in the same position that you were at when you began. Unless you're just trading SPY shares across VWAP. I mean, remember, he doesn't trade trends, right? So if it's a trending day, he doesn't trade it at all. And that's a lot of downtime. And in some markets, that's a ton of downtime. I developed my own system. Every time I'm up 3K on the year, I lose 6K and then spend the next month getting back to break even. That's actually moderately successful. Now you just need to get, like, if you can keep getting back to break even, you're in a better spot than a lot of people. I don't think any of them have ever read anything. Well, maybe Bruce. In between bagels or something. Grook's got MACD up on SPX right now. How dare you? There's a lot of Tesla fanboys. How far down or up do you believe AVGO can move after the dilution and the stock split? Well, wait, are they diluting? I didn't hear anything about that. The stock split, I mean, Delta will probably fall off the chain. Give me 1 second. Manu? I don't even know if I have data on that. It sounds obscure. I don't. Yeah, I really don't know how far down AVGO will move after the split. I'll have a better idea after the split. If it moves down at all. Most of Kevin's success is just from a lucky bet he made on Tesla years ago, and he's been riding that while trying to pose as an expert that should be paid for his opinion. Gross. I feel like Tesla was a pretty easy play during the COVID crash. Even prior to the COVID crash, right? It was really obvious as their bonds got upgraded that they were just gonna make a fucking ton of money really fast. And if they weren't, they were gonna get all the investment they could ever want. Dude, Manu has no option chain on it. Yeah, you don't need to pull it. Don't worry about it. Hmm. That's a little too slow. Dispersion's getting pushed up, but not enough. Forward yield on volatility is picking up, which isn't good. Hmm. It's a low support. Meta looks like shit. Microsoft is just bleeding today. Apple doesn't look great. Google failing. That is a pretty broad failure in tech. What's RSP look like? RSP's up 10 points. So the only thing holding this up is breadth right now? Hmm. 5e rank is very low going into an earnings release. Like 4. What could that mean? I mean, it could mean that the expectation for the earnings is very low. Well, that's exactly what it means. Yeah, so a surprise would cause a bigger move. Generally, you want to, like, if you're looking into something like that and you expect a surprise at earnings, you would want to, like, go choose something that goes long volatility, like a straddle or a strangle. You want to groan? Check DM. Yeah. Ooh, nice. 75, still a big resistance. What is this picture? Timeline on EPAM getting above 210? I don't think it's gonna. It's almost failed the trend on the daily. Well, at least not by June. It's rapidly running out of time to make the move. Maybe rescue their 5590 calls. Let's see. They need to push dispersion because breadth isn't enough to keep the market up. If tech is falling. GoEV tips haven't done much, but there's a little bit of covering going on. Not a ton yet. Beyond is starting to see a little bit of covering. Finally, just today. But also still not a lot. Microsoft bounce at 460. Apple's bouncing on VWAP. So NVIDIA and Microsoft need to turn around. NVIDIA's still selling off though. Maybe support at 30. But maybe not. Could fall to 28. Hmm. We've got the auction at 1 o'clock on the 3-year. Sorry. That should be most of the sell-off. So now we want to see support on S&P at 455.80. Okay. There's still a ton of support at 80 and 75. Ooh. Did Trump move his plane? Maybe. Fed fund futures still pricing in 0.5. Oh, dispersion slipped a little bit. Maybe should have stayed short. QQQ. Yeah, Nvidia dumped pretty hard there, but it should have some support at 28. $2 Go EV CSVs for Jan are paying at 96 cents. Would you consider this a good entry? I don't mind owning it at $1.04 if it falls back below 2 by Jan. May synth long at 250. Thoughts? Seems reasonable. I'm synth long at 2, but I had like June 19 CSPs, which I just closed out recently. I think I have some 250 leaps somewhere also. Did Bill Gates die? No, I think just some profit taking. QQQ did test 500 this morning. Deadlock? A third-person shooter Dota. So Overwatch? That sounds fucking terrible. It sounds great if it doesn't have a mode that makes me play with the worst people alive in every match. I mean, if the game's remotely good, they'll come with the territory. Hmm. USD 105.18 again. This is kind of unexpectedly weak pump into the auction. Fed bids 9.4 billion. Oh, Yellen spoke too. She said that she's just talking about Biden. What's the total being tendered? I think it's like 89 billion or 79 billion. Wait, I think I put it in the DD this week. It's a 3-year auction, so it's gonna be pretty big. No, it's 58, sorry. It's wild to think that NVIDIA would have to drop back to 18 to be at the level you initially shorted. It makes no sense. That's where it is now, though. 55.83. Hmm. That's a little bit of a stronger pump into the auction. Still backing off dispersion, though. Hmm. What's your Ulta PT? It's on the chart. If we do squeeze out the sold calls to the upside, I guess we could push out to like 56.10. Well, I think the auction's gonna have to be quite good for that. GME holding on to 24 is interesting. Is it? Maybe. I kind of wonder if we'll see XRT go on Reg Show. 1 second. Do you think FUBO will see 120 again before earnings? 120? Possibly. I'm probably not back to 110 anytime soon. IV's already starting to like tick up a bit. Yeah, that's right, Jay. As one of the former CFO of a public company who runs a manufacturing firm, he's telling me how there's a manufacturing recession nobody's talking about. I said, have you heard of Pi-Fi? I'm sure he hasn't, but thank you. Tesla might be forming a top. Needs to fall back below 260. It's way above Gamma Max. So the Fed can trade now? I need to find the document that they're referring to. But that's what someone implied. Ooh, bid to cover went up. 2.67 versus 4.339. High yield, or 2.67 versus 2.43. Sorry, high yield 4.399. Prior to the auction 4.407. Full bull, leverage everything. Right. I don't think Carvana is still above Gamma Max. No. Gamma Max on Carvana is at 130. I'm thinking of adding more to Beyond. How are the tips? They're starting to contract. Well, the front end of the curve's falling. There was no tail. I expect leverage ratios are probably a little bit better post-auction. We should see some push into dispersion now. Which I've been waiting for. That's pretty fucking tempting. Huh. So 5,600 or no? 5,600 is still going to be resistance, but we could test it. We need to squeeze short calls here. Otherwise, it's going to be really hard to stay over Vega neutral. Yeah. I think it's 55.88 something, right? 55.88.27. They need to pump QQQ. Basically, in order to keep going up and squeeze out the calls, we need dispersion to come back. And tech needs to move up. Otherwise, this will fail. You really feel the drag of the MM selling to the upside. Yeah. Are airline companies going to have some trouble in the near future? Or they're going to have trouble with debt? Do you have GN for now, by any chance? I might. Gamma neutral's 749.82. So it looks like it bounced off of it after the... Well, is bouncing off of it after the drop. I don't know what it's doing right now. Yesterday it was. Ew, no. Today it fell below. Yeah, so it's below GN today. There's a pretty big drop in Delta. Is there, I assume there was like news or something. FSLR back on track here. Perhaps. I think I'm gonna wait for 30 though. It's a better confirmation. And it failed 30 yesterday, right? Hmm. Futures looks okay. Volume's picking up. $56.50 might be hard to cross. It's very odd. Yeah, there's more resistance at 95 too. Any thoughts on CPI and PPI this week? There's a slim chance that CPI could come in hotter. Although the seasonal revisions were pretty rough, so I don't have a lot of confidence that it would. PPI, on the other hand, could in fact be quite a bit hotter. I think input costs have been going up pretty steadily. Does it alter your predicted time frame? No. I know you considered buying shorter term exposure. I did yesterday. Wasn't exactly at the low, but when it pushed back above 395, I picked up a few positions, like shorter dated stuff. But 400 is like a big psychological level, so I figure it'll probably won't break on the first test. You're gonna play a Tesla bounce off 290, sorry, 400, 300? What? I thought it was overbought. I bought some Vega puts. They downgraded, which is nice. Nice. Hotter? Higher rate of increase than expected, which is currently a month-over-month rate of growth of 0.1% for CPI. Anyone remember how long Beyond needs to be on Reg Show before magic happens? Well, forced covering begins 13 days in. T plus 13 from the start of Reg Show. I have a grin on my face every time we go above VN. And they sell puts and we fall back down. Yeah. They may still push for it again, though. Microsoft's kind of fucking everything up today. Apple still seems fine. NVIDIA could recover more. Dispersion's getting kind of borked. It's like that crazy run up we saw in the third when they push up, just overwhelm the but they have to really want it. They have to leverage it up a lot, which is hard to do when they're already leveraged up, and like conditions today are still tighter overall, even post auction. No likey. What's up, Dork? Red candle, yeah. But there's a gap. I feel like if we hold 55.80 and they can get VIX up to like 12.75, 12.13, they're just gonna short the fuck out of it. You can't just choose a different time frame and get rid of it. Costco? $901.46 for Gamma Max, which it tested this morning, I think, right? Or it came really close. $96. Close. Microsoft held 60. If you look to the downside, there's an even bigger gap. I know. But there's also a fuck ton of calls at like 75 and 80. You're forgetting about the upside gap from 5,600 to 6,000. Yeah, there are. They've been buying a lot of in-the-money calls today. It's be a shame if someone were to unbuy those. I don't want to sell my Amex calls, but it's leaving me no choice. Do you not like money? Interesting. It's very un-American of you. There's only one downside gap on the SPX that I care about. It's 41.20 to 41.33. If we could go and fill that, that'd be great. And when shall we see that gap, kind sir? But we only need to drop 26.5%. So, no biggie. The SPX doesn't split. Hmm. I don't speak Bantu. Be a lot cooler if you did. Did you close your put yet, Zurich? You're funny. What's up, 3 ports down? How you doing, man? If my calculations are correct, and they are not, we should close somewhere around 55.50. How about 56.10? Did EPM fall out of its trend at 182? Almost. It's being a real piece of shit, though. Actually, it is a little bit out of its trend. I don't like that. Yeah, well, a little bit. God, Bull, stop trying to make a triple bottom happen. You could have made so much money on your put before they shorted the fuck out of it. I don't think EPM gains much ground until earnings. I mean, that's why I bought shares too, right? I refuse to miss out on potential failure of a resistance for fucking once. Resistances don't fail, dork. Come on. We've been doing this for a year and a half. Resistance is futile. Kobayashi Maru. What's up, Nuke? You got goodies? Ooh. I like it. Check pumpers sound like those guys driving lifted pavement princesses with truck nuts to Trader Joe's. Don't forget daycare. Did Nuke full port 5600 0 DTE calls? I hope not. What's going on here? Bulls are catching a knife. They stopped the MM hedging off their long puts by selling the MM even more puts. Is Nuka degen? Oh yeah. Yeah. He's got it bad. They already stopped it and turned it around, or stabbing the MM with it a little bit. They still need dispersion, or they're not going to get this where they want it. No, I wouldn't say this is a good time to buy 0 DTE puts. Bulls out here, like, here, bro, let me hedge your hedge with my hedge. It's fucking ridiculous. It's like, oh, quick, guys, we sold too many puts. We should sell some more. Is it anti-Semitic to be short EPAM? I don't think so. Are Nuke and Nuke related? No, no. I was gonna make a lame physics joke, but it's better that I don't. What? No, about nuclear families? I like the energy. Hmm. It's too early to win, right? I feel like charm's still a problem today. I like the stream card. Can we bring Ken in as a guest? That'd be fucking awesome. I mean, we bounced up enough that we should be stable here. Not necessarily easy to pump it, but nothing's pressuring us down at above 55.80. They just had to reposition the dispersion trade, right? Could we just get a negative 2% intraday move? It's been over 3 years. No, it hasn't. It's just been a while. Didn't we get one in October 2022? I think we had one last year also. We've definitely hit negative 2% intraday. I don't know if we've had a negative 2% close since like what, March or December 23, 22. Because I know when they pulled back YCC, we went down hard as fuck. That was like it was like 8% in a week or something like that. Yield curve control, not Yahoo credit cards. We're a lot easier to go down like 1.6, then rip up 1.8 the next morning. Yeah. Or overnight. Is this Thursday our only real chance for some realized vol? No. Friday too. But it'll probably be the usual, right? Like pump, and then flat this week, then pump next week into SLD, OPEX, and then failure after. If they really want to pump out a CPI, they're gonna have to dump today and tomorrow. Hmm. I don't know. They could just reposition puts closer to the money, right? And push VN up. Don't forget that they're still just not selling in the money puts right now. Because it's insanely risky. But do you project cooler CPI? It'll depend on how efficiently input prices are being pushed forward. The consumer's far more exposed to input prices than services prices. And so, you know, the fact that service prices are declining but input prices are rising should mean that in the near future at least we see CPI move up again, especially if producer prices continue to rise at the rate they are. But it doesn't have to be right now, right? That's going to depend on the efficiency. And the consumer is getting a little bit stronger from the wealth effect, but it's not a lot stronger, right? Like every time we do this, they're a little weaker at the peak. Are you saying we're pumping into close? If we hold here and the short calls to the upside start closing out, absolutely. I mean, they've never really stopped selling in the money puts before. The last time they stopped selling in the money puts was like end of March, before the April correction. These oscillations between tighter and looser financial conditions are probably going to pick up pace as long as the Fed continues their rate policy of not doing anything. But unfortunately, this is still the best path forward. Not selling in the money puts. Did your cat ever just meow at the wall? He doesn't really meow much, which is weird for me, because my last cat did. He's pretty quiet. The Fed has amazing tools. Anyone who talks to JPOW. Have you figured out how to keep him out of the air duct? Yeah. I just screwed it down to the floor. It's like no volume. What the fuck? What did you think? Bears were just gonna show up? Because you bought a put? You're probably one of the only people that like has the buy to open put at that strike. No. There's no reason to try to pump right now. Not at least not until Charm's gonna help push the upside, right? Flat here until 3:30 is much better. And then if we drop a little bit, sell more puts, push us back to flat. Keep doing that until 3:30. EBITDA earnings before I trick dumb auditors. Short duration puts are fine. Longer duration puts in this market are dangerous as fuck. I didn't screw the cat to the floor. I said I got a new vent cover. I was pretty specific. I didn't even leave that open to interpretation. Can anybody in Europe explain to me why the euro sucks so much? So my September 5450 is dangerous? Oh yeah. Really, really profitable if it goes in the money or we drop. But it's definitely dangerous. Puts are so dangerous, my debit spread is worth less than 0. The Chewy cost craze over, or is SS still on the hype train? I have no idea. I need to pay the MM to sell it back to them. You could leg out of it, and you might be able to avoid that. You know what else is dangerous? Unfortunately, shorting Tesla. It's not time yet. It's only up 40%. Sorry, 56. Big Red Donger, go and go and go Red Rocket, go. This is awkward, dork. I've never been in Super Stock. I was one of the lucky ones. Made it straight here. Kind of spoiled. Is the bottom on Zaman yet? Probably not. Look at that Vic short. There we go. Coin at risk, yeah, that's got a little range there, though. It looks like it's getting support. Bounced off 1870. Should I add to gold here? Dangerous. Alright, we just need like a 20 standard deviation move into close. Is there a reason Tesla's up almost 50% in 2 weeks? Or is it just the sheer willpower of Elon fanboys? I think it was the only Mag 7 component that had moderately cheap options. So all of the dispersion just got pushed into it because everything else was pretty much maxed out on market cap. Even Elon fanboys don't have that kind of money. It's probably going to take a little while for Tesla to break down. But I wouldn't be as surprised at a return to like 240 over the next couple of weeks. 240, maybe 250. Probably need to wait for vol. Yeah, probably need to wait for like volatility to fall under HV or for HV to climb over IV. And then once like vol shorts start coming in on Tesla, it'll probably start to move down. They don't repair people's Cybertrucks. Why would they? Those people can't sell them. Has covering begun on GoEV? It's getting a little bit. It's not been a ton, but it is getting a little bit of covering. I really should be long the Microsoft like 360, 250. Schadenfreude is tangible and absolutely delicious. There's an entire subreddit dedicated to people owning Cybertrucks and how awful not only the people who own them are, but the truck itself. Like just driving down the highway and all the molding on the doors falls off. There's a great video of like after they updated the software for the trunk closure, it wouldn't like slice your finger off anymore. And this guy like sticks his finger in and gets it crushed. UCO puts. I'm not short UCO. I was long. I got stopped out of a lot of it. You mean the calls? No, not yet. I still have like 10% of my long position there. 20 maybe. Sounds like a sub that's run by Tesla's competitors. Why would they need to? My favorite two Cybertruck videos are the guy bragging that he can load 5 50-pound bags of cement in the back, and another one where it slowly drives down a moist dirt road, and they call it off-roading. There's one guy who went out like on the dunes and fucking rolled his Cybertruck, and it's just in pieces all over the side of a hill. That one's pretty funny too. There's lots of those. I'm on all of them. Nice. I'd expect nothing less. Enough Musk spam? I haven't seen that one. Here's Jerk's second opportunity to finally make money on his put. Does anyone in this chat own a Cybertruck? I hope not. But probably. There was one guy that used to be here that was like waiting on his that he pre-ordered, and I made fun of him, and then he left. Why do you think fucking Bill Gates is still short Tesla? You know, when Bill Gates announced his short Tesla position, it was trading at like $1,200 a share, right? It then proceeded to drop 75%. And you think he just stayed in? Should I cut this call that's down 95%? It's up to you. It's an El Camino with a cab cover. I think it's more like a Pontiac Aztec, isn't it? Devil Wears Prada officially gets a sequel. My guess is the Devil will be wearing Kirkland due to the economy. No, Kirkland is Prada due to the economy. Random NC, welcome to Zillionaire. Thank you so much, man. Hit me up on the Discord. I'll get you added to the country club after the stream.
Yeah.
You just asked retail if they understand short positions. You're gonna be disappointed.
If you are what you eat, that makes Gherkin the go. Hoping that you read the DD, cause when the shit squeeze, we go end up with the moon, man. Racks to the 5 10 weeklies while I'm selling CCs like a
Oh, I have these things. Hold on.
RC and the BY, please, cause I need G and me to move soon, man. Got the man GG on the CNBC saying that he ain't seeing no collusion. Yeah, we might be apes, but we ain't that Joe. Motherfucker, trade this popcorn code. When the Citadel fails, I'm a bomber on both. Sail the Elliott waves like a
Boom, take that, pores.
Yo, but we ain't no cult.
Yeah, I still haven't turned up from the thing. It's good. Wakes you up. Ooh, QQQ's not pulling back as much on this dip. Dispersion. No, don't give up. You can do it. QQQ could still end the day up 90%. What would you suggest to a disgruntled bear who's having trouble going long on anything? You know, going long treasuries is bearish. You mentioned yesterday you expect a correction by the end of the month. I said next few weeks. Could you expand on why and perhaps the range? I think the dispersion trades push to its limits and financial conditions aren't loosening enough to support it. And so we're gonna get at least some moderate breakdown in the dispersion trade, which we're actually getting a little bit of today. It's quite frightening. It's much sooner than I want to see it happen. Range, no idea. I mean, Vol's so oversold that any like small correction, like 3 to 5%, could easily turn into 10 to 20 to 30, 40%, 50, 90. Why not? Does that mean the coin play might go bad? I mean, coin doesn't benefit a ton from dispersion. I checked that before I went long on it. But it will require that BTC continues to move up. Which it should if the dollar stays strong, right? Which I think it will. You know, it'd be an even better print for the Bears on Thursday. Hear me out. Negative 0.5%. One sec. Dispersion, difference in Mag 7 volatility over index volatility? Not exactly. I mean, we generally watch like correlation 1 and 3 month, and that would be the top 50 stocks in the S&P, not just the Mag 7, although they are representative of most of that. What's dispersion? Shorting index vol and longing the underlying components, or vice versa. Do you see this bullshit, Dork? When's Sava? Literally never. That stock sucks now. Used to be fun. Oh, come on, Microsoft. Hold the keys. So Occidental's gonna sell Microsoft 500,000 metric tons of carbon dioxide removal over the next 6 years. Huh. Buffett's such a crafty little bitch. Ugh. Apparently bullish for Oxy, but not great for Microsoft. They're opening a carbon capture facility in Texas. How long until carbon capture is made illegal in Texas? Texas will and would never do anything to hamper oil industry profits. All right. Bullish for Oxy because carbon capture is a scam. Do you not believe in carbon? SSC looks to be at generational dip buying levels right now. Are you still bullish roughly 1 year later? I wasn't bullish 2 weeks later. You gifted me a membership. I don't know what you're talking about. I am carbon? Are they gonna capture me? That's called a prison. We're carbon, and I don't believe in me. Checkmate. Thanks, man. Daniel's on the go today. I see. Still out of the money calls to go get. They're sold. There's out of the money calls to go squeeze. Well, most of them are sold. I was having a crummy day, and that membership was appreciated. You're welcome. Glass Kegel, you have an excellent handle. It's actually a spout. I don't know why people in here are expecting downs. They like to buy puts. It doesn't matter what I say anymore. Everyone blames me for being, you guys are all way more bearish than I am on any given day. I don't like making money on calls. Honestly, that's fair. It's usually pretty awful. You taught me about bears? Is market correction the same as MOASS? It's not real. I'm still happy to be here. We just had a correction in April. In the last 12 months, we've had a 15 and a 5% correction. Dork said downs. Dork bought a put, so we're definitely going up. He also didn't sell it when it was at peak profitability, and I told him to. There's people in this chat that would kill me. Would kill Dork to have me as their financial advisor. They'd probably kill me too. But and Dork just ignores me. He's like, nah, man, we're gonna go to 5,500 end of day. I can't hear you right now, but I know you're talking shit about my put. I'll just have you know, penis, 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 balls. All right. Remember that day I told you to get a HELOC and sell 54.75s? You could have paid your house off. I made 20 trades for 40 bucks, winning. Are you trading like MES or something? Here, I know you're busy in a work call, Dork, so. Fuck. Why are bulls struggling here? That's the secret. They're not. They're absolutely fine. There's just no point in pushing yet. I can't wait for Gherk to be horribly wrong for once. Thanks, man. If not dropping, bulls are winning. Yeah. Scaly, welcome to Zillionaire. Thank you so much. Hit me up on the Discord. I'll get you added to the country club after the stream. Appreciate it. Ass? I need to make a new Dillionaire song. How different is Dillionaire from Pigeon Whale? They're basically the same. Oh wait, no, Dillionaire get or Pigeon Whales get access to the data beta that we're releasing. Paid access to the data beta. Access though. Are we still selling puts on Apple? No. Not still selling. Still have some out, but they're like way the fuck out of the money. Data beta is a good phrase. It is. Oh, Pigeon Whales also get the they get the DDS-DD. What did you say about earlier about CMG? I don't like it. I said, well, yesterday and earlier. What if I only joined to hear that awesome song? It's just dated. I'm a data beta. I love data, but I don't know how to act on it. The first rule about DDS-DD is that we don't talk about DDS-DD. How high do you see bulls pushing for end of day on SPX? Still between 80-90 range or possibly up toward 5600. Depends on how hard they push and if the 0 DTE sold calls squeeze off or not. And being able to push still requires that they're able to hold these levels. Have you checked out Udio for creating a new Dillionaire song? Yeah, but then like the AI music doesn't have the same personal touch. You know? What's your PT on EPAM? I'd like to see it get back to like 250-ish. Long term. Instructions unclear. Full ported Dillards. Ooh. Fair enough, Glass-Kegel. You can write all the lyrics and just have it do the music. I've never really tried my hand at songwriting. Interesting. It's not me. I'm not a musician by trade or practice. Is this it, Dork? Is this peak profitability? Just hire someone on Fiverr to make you a song. But then it's not, it wasn't, but then the song wouldn't have been made in love. It would have been made for financial gain. Financial gain is love. Did you end up figuring out why FSLR was underperforming versus Enphase? Oh, that one was easy. Enphase had a bunch of puts pull back after it bottomed. So like all the bears took profits, and there's still a bunch of bears on FSLR that are kind of getting pushed out of their positioning, but they're still there. Oh, there's so much more VIX to short up here. Colt, Bolt, Jolt, Fault, Halt. Vault, Salt, Molt, Default, DeWalt, Adult, Consult, Result, Exalt, it's run Assault, Insult, Tumult, that's all I got. Plute? Plute doesn't rhyme with Colt. Catapult, yeah. You forgot the U, NW. But yeah, I said that already. Is what we're seeing spikes in the VIX? Probably just seeing repositioning and dispersion. What's an assault? It's assault. Revolt. It's more of a slant rhyme, like jolt. Dork's put in shambles. Yep. Humboldt. Okay. Specifically the penguin? It's also a town in California. City. I actually don't think slant rhyme is a racist term. I think it's racist to say that's racist. Yeah. It feels like projection. You know what is racist? Chinese, Japanese, dirty knees, look at these. Straight to jail. Why did Oriental become racist? I think because it implied that all Asian people were from the Orient. I think it's only offensive if you describe somebody as Oriental, though, not like an object. That's what I keep telling my wife, but she still gets mad at me when I call her that. Thanks, Glass Kegel. Interesting. Seems like I've never really ran into a situation outside of like describing a rug where the word Orient was the first one that popped to mind. I'm assuming you're half Asian, not the FBI. How's your crip walk? Not as light on my feet as I used to be. It's basil, not basil. How much do I have to pay to see your crip walk? You don't actually have enough money. But I appreciate the effort. Is what racist? Basil? I don't know. I actually have a buddy of mine that I went drinking with like the other night who just informed me that purely my existence is racist. I was pretty drunk when he told me, and I actually thought about it for a while. He's also white. I should probably point that part out too. He's way whiter than I am. Did you slap him? No, I left. He's racist for calling you racist. Yeah. I'm not Persian. I'm not sure what you're talking about, but I'm offended, I think. Exactly. Did he say he was racist too? No, it was purely about me. Did you slap an Asian lady? No, Jesus Christ. Do you think that's what I do with my time? Just go around slapping minorities? Yes? Why else would he call you racist? It was actually because I tipped the bartender. She was a black lady. And apparently, because I tipped more than 20%, I was being racist. And that started like a whole conversation about how I couldn't not possibly be racist because my ancestors were colonialists. And I was like, your fucking ancestors were. He's British. I'm not even British. I'm like Irish and the Italians haven't colonized anything in like a little while. I said a little while, Sistani. Have you been to Boston? Yeah. She was just a good bartender. It wasn't like a race thing. I wasn't like, oh, here, let me write off my white guilt with an extra 5%. I don't have any guilt. It's ridiculous. All right, Gherkin, real talk. What? Centaurs have set hoof on many a continent. I don't think that's true. I have 0.01% Nigerian ancestry, and this conversation is making me uncomfortable. Yeah, but you have a stronger claim to your black card than Rims and Tims. God, I hope he's here to hear that. He is. Perfect. I have no guilt. No truer words have ever been spoken by you. You shame your ancestors by denying your Persian heritage. I don't have any Persian ancestors. I'm not Greek. Have you ever done the 23andMe thing? Not 23andMe, but I've done like an ancestry test before. Different subject, but Seeking Alpha should be a dating site for furries. Particularly dom sub wolf furries. Wow, you really know a lot about the furry verse. Is the S&P up yet? I'm not even watching it. Oh, yeah, it is. Cool. I wonder if Dork still has that put. Greece DNA test. 1/3 Italian, 1/3 Clydesdale, 1/3 Persian. You're more like off-white. I haven't been in like direct sunlight for years. If I get a tan, everyone's gonna think I'm Mexican. It happens every time. Which is also racist. Get a tan? I'm not Mexican. I'm part Spanish. A racist, not financial analyst, and a furry sympathizer. I found my people. Hold on, I didn't sympathize with the furries. I just acknowledged their existence. You guys really are setting a low bar. Are your calves the horse part? No. The old I'm not Mexican, I'm a conquistador. I don't think I'm one of those either. My great grandmother was Castilian. On my dad's side. All my grandparents are from Spain. Oh, okay. Was that like Bastille Day? No, well, I don't know, actually. Maybe. I think I know how Gert came to be. Zeus came down and messed around with a centaur horse. That's why he has iron calves, Zeus calves. Plus, Zeus was Persian. No, he wasn't. Oh my god. Great. I'm a Mexican living in Castillo, Leon in Spain. Nice. Taking it back. I like it. How looking like a good buy? I'm thinking of averaging down. I bought a few more leaps the other day. According to Thor 4, Zeus was Australian. I thought Zeus was Hannibal Lecter. Leaps on what? He was talking about how. It wasn't even, he's not even Zeus, he's Odin. Jesus Christ. Ribs and Sims is definitely a black ass name. I never thought about that. He's the whitest person in here. He wears Sperry's and his parents live on Long Island. He watches NASCAR? No, no, that's cruel. Does he wear a cashmere cardigan? I don't know. Why don't we invest more in horse-related stocks? Like Gurned? What the fuck is Gurned? Wider than Wayne Brady? Wayne Brady is a bad motherfucker. Have you gone to a professional sporting event before? And if so, what? I think I went to a baseball game once. I'm about to listen to Will Smith and get into the zone. I went to a show in Amsterdam Red Light District. Does that count as a sporting event? It's professional. SPX 5600 overnight. I'd much prefer it did it right now. Well, over the next hour. Just need someone to buy some Microsoft. What's going on with SPX here? It's chopping. Delta and Charm are slightly negative. Well, Charm's actually a lot negative, but Delta's slightly negative. and dispersion keeps breaking down, especially on the 3-month. Starting to think we might get a leg down. There's still a lot of support here. Is the move due to squeezing out some shorts? No, not really. There actually weren't a lot of shorts left. Positioning on Tesla was fairly neutral back when it was at like 170, 180. It's just a ton of dispersion trading. Like everyone just went long as fuck vol on Tesla. I'd say if anything was like a catalyst to it moving up, it was probably Volkswagen giving Rivian a bunch of money. Not that Rivian's ever done anything relevant with the money they've had in the past, but how does that make any sense? Vol on the basket, like the sector started to move up with Rivian like doubling in price. And so everyone just went long Tesla because it's the biggest component of the sector. Long vol on underlying is very bullish. Long vol on indexes is bearish. It's kind of far from here for just an hour. I'm not saying we will. Like, there's a solid amount of resistance at like 90, 95, 5600. Actually, there's pretty much resistance all the way out. But if the short calls squeeze off, because they're all 0 DTEs, then yeah, we could rock it. %80 of hedge funds are short Tesla, allegedly. Allegedly. If they weren't short before, they're going to short it now. Do you think we just hold this into close? It's possible, yeah. If dispersion doesn't pick up, but they're trying to turn tech around, right? QQQ's in an uptrend despite SPX trading flat. What strike is most concentrated on the short calls? I think it's still like $600, $610. 95 still has a decent number of them. I would say 95 and 610 are the two highest concentrations. Right now, there's like no gamma on those strikes, but if we move up, there will be. We once said IGI could go as low as 2150 in the near term. Do you still believe that? Could go as low as? I don't even remember which one that is. Probably meant UGI. Oh, that would make more sense. UGI can go down to 2050. There's support between here and there, but if it hit 2050 again, I'd probably buy more. Short Maxon missed the boat on that one, no? What are you gonna try to seller box it? How low can Tesla go by like October, do you think? No idea. Honestly, the options positioning hasn't even caught up to the upside move yet. But I would say once we start to see vol get shorted, it's probably going to come down pretty hard. We're getting some of the short calls starting to close out already, but nearer the money. And Delta's still negative here. First step to something bullish happening is probably getting back above 80. It's the freaking trend test again right here. A bit of support. How's NQ looking? Not enough time for that to turn around. Although, that could be kind of bullish. Nice recovery on Nvidia. Still no recovery on Microsoft, though. Amazon's doing okay. Oh, Google's got a higher low. That looks kind of meh. AVGO found some support again. Yeah, still looks like all that matters is Microsoft. BOJ increasing rates. When's their next rate decision? August, I think? I know it's power hour. I have Microsoft calls at 460. Maybe I'm just too bullish. How likely do you think a break below 75 is? We could. It's support, but we could. Charm isn't great here. That's fine, but it'd be better if we moved up. Like above 80, 85. A lot more supportive. If we lose 75, Charm goes the other way, though. POG rate is the day before the FOMC. Okay. The night before? That'll be fun. They might raise rates this time. They're definitely pulling back some of their bond buying. I know that. How likely do you think a break below 75 is? We could, but even if we do, we might just bounce back above it. I feel like it would just lead to more put selling out of the money. I'm kind of interested in what's going on with tomorrow's expiration, though. Still getting a decent amount of volume on calls. Puts a little bit at 70, 75, but those might be being sold. RSP now down on the day. Russell Dow down. Oil's moving back up a little bit. Gold bounced. Yeah, Microsoft's starting to bounce a little bit. It's got a ways to go. Needs to get clear of 460. And then I could move up. The NVIDIA bounce is turning into a reversal, almost. Play the bear song for MOASS. If I play the bear song, the market will go down right now. Raising rates would help banks, BOJ? No, it tightens the spread. It'll tighten financial conditions. Prove it. You can't just use the songs for evil. They're not market indicators. They're just songs. Since always. BNet at 7:31 and I'm an OG. It's time, Gherk. I will not. Are you holding Microsoft overnight? Maybe. If it breaks like 462.50, yes. If it doesn't, probably not. 318. $6.29. Beyond's got me all sad. Why? Did you get a shitty entry? What would you consider a healthy pullback for like a bullish continuation? 2-3%? Macroeconomically, 20-25%. The July 19 calls are down big. Not really enough theta, but alright. That makes sense. %? I mean, that's personal though. Have your thoughts on housing developed? I think I put a video out like last week that covered like a pretty extensive discussion on housing currently, or at least my current thoughts on housing. End of day thesis changing? No. I still think bulls will try to push it before close. Futures is getting a little soft, which I don't particularly like here, but might not be a big deal. Even if it slips 75, there's still support. Not really. Hmm. Charm's gonna get rough here if we don't move up. 323. Hmm. It's an awful lot of consolidation. You say things like bulls will probably push end of day. How do you know that? Data and experience? Largely. Where can I go to learn that kind of projection insight? You could do this every day for 24 hours a day for the next, like, 7 years. Largely, it's based on the positioning. I can't see into the future. Calls are sold pretty heavily at like 80, 85, 90, 95, 5,600, right? As we move into the end of the day, gamma on the near the money strikes will start to pick up, right? And since those calls are sold, the gamma on them will pick up, and hence the risk of holding them into close will pick up. And so people who sold them earlier in the day will be encouraged to buy to close them. As they buy to close them, the market maker will long futures, right? And so, and then that, is reflexive. So the more the price goes up, the more the MM goes long, the more encouraged they are to buy to close. Actual finance experience and data, not centaur magic. Yeah. But, a little bit of centaur magic. Not a centaur. How close are we to the beta release? I've been instructed not to say time frames, but close. We're doing like bug fixing and stuff now. Everything for the initial beta launch is done but not perfected. When's the cutoff? I think I'm gonna make the cutoff the live stream, which I would like to do before next week. So you don't have to be a pigeon whale because we're gonna release it publicly, right? It's just if you want to be in it early, you do. Are you gonna stop streaming? No. What does that have to do with it? Or George R. Martin close? No, we're not. We're not that far off. Like I'm on the website right now. Like it works. There's just some more stuff that needs to be built out and some fine tuning. A lot of fine tuning. It'll be a super cheap subscription of $1 million a month. No, it's not. Gotta fix Dork's code. Could Pores watch the live stream to see it? No. maybe we'll like, maybe I'll like unlock the live stream before we go public, but probably not. Dude. Gene, welcome to Pigeon Whale, man. I appreciate it, dude. Sneaking in there at the last minute. Well played. Well, 50% correct. Fix inflation? Probably, yeah. Or at least put a serious fucking dent in it. And the wealth effect would get wiped out. You should devise an affiliate scheme with other FinTubers, except rather than a discount, it quadruples the subscription price. I'm sure Meet Kevin's viewers will jump at the opportunity. I don't think Meet Kevin's viewers know what the fucking option is, right? And you presume we do? Well, I'd hope. After trading so many of them. Fucking Microsoft. Is this a reversal? Kind of. Futures is still a little weak. And there's no fucking volume. That's interesting. Hmm. VIX is getting kind of close to backwardation. Hmm. What's up, Dork? How's that pump going? Better than your put. Have we heard from Popcorn Trader, or did he get caught in the flooding? I thought he was here yesterday. Go, 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 EV. Oh, look at that. It's trying to do stuff. Yay. Mm. My face, your ass. Yeah, I mean, your ass. That's the same thing. Short calls seem like a game of chicken. Yeah. Texans are using the Whataburger app to track power outages because the state doesn't have an app for that. I hope Popcorn Trader is okay. I'm gonna DM him. Thoughts on guts. $5 in the money each way on SPY? How's vol pricing on SPY right now? So the 50 and the 60? $7.15. It doesn't seem bad. Carry through Friday. She need like a 0.7, 0.1. I don't think it outperforms a straddle. Yeah, it looks just worse than a straddle. Are we bullish for tomorrow? No, not really. We might move up again, like overnight, to where the short calls fall off. Like we did last night, but I don't think that's necessarily bullish. Groovy borrow rate 561%. Interesting. They have an event tomorrow. Seem fairly distributive on futures here. No, we've got a little bit of a bounce on the 15. I think a push back up to like 56.35, 56.40 could be possible. We're gonna need a lot more volume to come in though. And we've only got 20 minutes left, so it's more likely that we see them move overnight than intraday, but we're not too far off of the sold 80 calls here, so we could push those out, and if we push those out, we could kind of cascade. Honestly, resistance at 55.90 is probably too strong to go much higher than that, but I could see us test 85 or 90. Alright, did fucking EPAM bounce off of that shit yet or no? I'm just gonna close this fucking... Yeah, it's fucking chopping. Hmm. How do I upgrade to Pigeon Whale? I think there's like a link in the description. Where it says like become a member or whatever. This started selling CCs. Game changer. Thanks. Nice, dude. Well done. Selling CCs is pretty awesome. Hmm. Fucking calls are overpriced. Oh shit. Nice. Was a single 250 call gonna make me rich, or did I just throw away $11? You'll find out. What's the over-under for analyst upgrades on Tesla after their earnings report shows a loss of revenue for 3 straight quarters? I mean, dispersion will probably break down after earnings anyway, and since Tesla's such a strong beneficiary of that, even if their earnings aren't that bad, which they will be, the price of the stock probably won't be able to hold these levels. Oh, fucking come on, Bulls. 15 minutes. Let's go. What is this bullshit? Can't get out from under the fucking charm decay? It's embarrassing. Hmm. That's not good. Volume sell-off left a gap to the upside. Nvidia's resistance is at 32. AVGO turned back around. Hmm. Is the BOJ meeting next week on Monday? I thought it was right before the FOMC meeting. I don't think so. No? It'll be after their inflation report, whenever that is. $5,000 Chewy 719 calls at the $30 strike just purchased. Interesting. Probably have to be on the desktop for the upgrade. Maybe, yeah. Is Amazon gonna break through 200? There's actually a bunch of call interest sitting at like 205 on Amazon. But 200's gonna be hard to, probably kind of hard to break. There's a lot of short calls there. Or at least hard to hold. My $2 GUI leaps are priced at 67 cents. The price is wrong, Gherk. Yeah, no shit. And there is a little volume. Not much. 10 minutes. Delta's still negative right here. Charm's not much better. Some of the short calls are closing though. It's like 80, 85. I'm not watching both of these. Fucking pump it. All sellers at 80 and 85 are going to be a problem. As long as there's not too much profit taking though. That's maybe too much. Go EV tips are diverging. So it's been getting some covering. Well, diverging on the daily. It's getting more liquid, so there's covering going on. It's just not a lot of it yet. Stop killing Microsoft, fucking assholes. Selling Microsoft to buy Nvidia. Ooh, Apple's got a nice little pump going. There we go. Those are still kind of unimpressive. Meta's selling off too. Dispersion's turning back around a little. Is Jimmy going down tomorrow because the FTD period is over? Yes, this should be the end of it today. Maybe. I don't know. There's a little like little bit of negative arbitrage on it. Gross. Bulls are losing the battle against charm. Ooh, rough. Is Vol gonna close over 1250? When was the last time that fucking happened? Or VIX? Closed at 1250 the last. I guess it was a little bit over 1250 a couple days ago. MM wants us back at like, here. I mean, yeah, it's not. We're not too far off. 78. Should be like right in the middle of this range. Two minutes left. Boring days, boo. Yeah, they suck. Not enough. Stuffed. Lame. Looks like we're gonna close just above 75. Ding ding. The MM wins. I wonder if ES will bounce now that the charm's off. Interesting. Well, slightly up, but basically flat as fuck again. One more time with the highest part of the day at the beginning of the day. That's usually not a good sign as far as moving up goes, and that might start to turn a little bit more bearish into the back half of the week. We keep closing our days lower, and all of the moves are in the overnight session. So I expect that again tonight. I expect that we could see another move up with the short calls falling off and there not being an MM hedge overnight to fight back against. We may see bulls push up into that like 55, 85, 55, 90 range once more. Commodities falling today. Mostly it looks like oil. Yeah, a bit of a pullback in energy. Precious metals kind of underperforming, but gold doing okay. Dollar stayed pretty elevated today, despite the drop in yields following the J-Pow speech, which didn't even really mean revert, right? Like they're still staying pretty elevated. We have the top end of the curve moving up, although the 10-year did fall back below 4.3. Correlation really never got any traction today. They kept trying to push it back. And with the dollar moving up and yields moving up, leverage is at a premium. So they definitely weren't able to push it as hard as they would have wanted to. I'm sure squeezing out those short calls would have been great for them, but still extremely low, right? So I mean, it's not like short vol's broken down at all. It's just having a hard time leveraging up more. And we saw a lot of that attempted leverage here with the US JPY carry. Leverage pushed up pretty early in the day, and then it kind of fell back as they gave up. Yield curve's still kind of uninverting a little bit, but alongside that, we're seeing demand for volatility pick up as more and more people position long bonds, right? If this goes positive, that's very bearish, right? And if these are both moving positively, that's generally extremely bearish. But also highlights the fact that, the market's pricing in a lot of rate cuts as well, or, presuming a lot of rate cuts for next year. Bond volatility moved down yesterday. 3-month correlation started to kind of catch back up to bond vol, but not very much. A little bit more tail risk hedging picked up last night. Still no fucking breadth. 47.11% of the S&P over its 20-day moving average. Russell down on the day. Dow down on the day. Those were supportive earlier. And RSP was up earlier, but it just continues to bleed despite the morning pumps. Correlation on VIX, cash VIX, still remains positive. And we are fairly close to seeing some backwardation there. VIX futures just under 12, and cash VIX at 1250, right? So only like a 50-cent move to see VIX move into backwardation. We continue to see VIX 3-month climbing, right? This has been pushing up for some time from its low a few weeks ago. We're definitely continuing to see that move higher, and this is pushing up that forward convexity, right? Fed fund futures still pricing in 2 rate cuts, so no change with Powell's speech today. Nothing particularly interesting, and honestly, they probably would have been able to push dispersion harder if Microsoft hadn't picked today to announce their purchase of carbon credits, large purchase of carbon credits, which definitely did a bit of damage to the stock, and we don't really see that money going anywhere else. I mean, Apple had a pretty okay day. Nvidia did okay today, but still both closing lower than their intraday highs. Meta looks like it's starting to fail, and if it loses the 530 level, actually doesn't have a lot of downside support. Google's starting to top out a little bit. Amazon still consolidating, but a breakdown from this consolidation would be pretty bearish, right? Especially if it fails to break above 200. There is still some out of the money interest on Amazon at like 205. That's unrealized so far, but and that would be the target, obviously, if this did break up over 200 and held, which it's not been able to do. Tesla is also probably getting a bit exhausted here out on the 1 hour. It's still trading like substantially above Gamma Max, starting to run out of upside delta. Doesn't look like a lot more is coming in out of the money on the chain, but Tesla still generally picks up the majority of its bullish positioning into the end of the week as options start to price down and more retail picks up gamma. So this may still continue out for a few more days, but it's gonna slow down. Yeah, that's about it. Netflix is maybe looking a little weak with a lower high here on the daily. I'd like to see it fall back through like 85 or 80. Yeah, if it fell back through 80, I might take a short on it. Super risky though. Beyond, yeah, I mean, Beyond started to see a little bit of covering today. It got a little shorted into the end of the day, but the trend so far over like the last 3 days is we're starting to see some covering. Generally, it starts off really slow and then picks up momentum, right? If you look, back at this period from where like covering started, right, until it actually started to run, you generally have a little bit of time. I usually go long with leaps here. Not only are synthetic longs just super cheap and usually advantageously levered, but they give you a lot of theta to wait out like whatever move it gets. I will say that more and more puts are being sold on Beyond right now, and Gamma Max is pulling in towards spot. So is GMDN, and as those neutral points move closer to spot, the chance of the hedge flipping is going to increase, and increasing volatility as it goes into earnings is only going to accelerate that. So yeah, I mean, I'm still long on it. GoEV's broken out on the daily. We're starting to see a little bit of covering. It's not a lot yet. It's definitely not a ton of volume, but the volume is picking up. If we go out to the 4 hour, you can see that a little bit better. But still very far from a crossover, right? Like any kind of substantial volumetric covering. 800 June 2025. Go AVGO leap calls. Copy Pelosi. I'm already long AVGO. I bought some more today when it bounced at 17. Fucking stock is awesome. Just goes up like $50 intraday. And then it falls right back to spot. You just buy it again. Anyway, thanks. No problem, Jason. All right, guys. Thank you so much. I'll see you later. I hope everybody has a wonderful night. Peace.